Hi, and thank you for joining us for our virtual gold conference. Gold was up 25% in 2024, making it the best year for gold in over 14 years. What's driving this demand for gold? Central banks continue to buy gold in record amounts, acquiring 25% of global production, and they're doing so to protect their US dollar reserves against never-ending inflation. President Trump is implementing lower taxes, higher tariffs, and deregulation, and investors such as Stan Druckenmiller and Paul Tudor Jones believe these measures will lead to more inflation and therefore higher gold prices. Another factor contributing to the higher gold price is record debt levels. The federal debt is at $36 trillion and is growing by $1 trillion every 100 days. And interest expense to service this debt is at $1 trillion annually. Where is the gold price going, and what are the benefits of investing in gold and gold equities? To help answer these questions, we have assembled some amazing speakers, beginning with John Ciampaglia of Sprott Asset Management, followed by Jamie Porter of Agnico Eagle, Paul Tomory of Centerra Gold, David Garofalo of Gold Royalty, Chris Vermeulen of the Technical Traders, Roosen of Osisko Development, Sheldon Vanderkooy of Triple Flag Precious Metals, Konkin of Tudor Gold, and we conclude with Joseph Cavatoni of the World Gold Council. We would like to thank our corporate sponsor, Sprott Inc., a global leader in physical gold bullion trusts and gold equity funds. Don't forget to subscribe to our channel and hit that notification button so you can be kept up to date on upcoming events. I want to thank you for being with us today, and I hope you enjoy the conference. John, gold was one of the top performing metals in 2024. It was up approximately 25%. And with this move in gold, I'm curious how the flows were into the Sprott Physical Gold Trust.
Yeah, well, last year was about $400 million US dollars came into the Sprott Physical Gold Trust, which is obviously an enormous amount of money. But relative to the performance of gold last year, we were actually a little disappointed with that. We thought there would be more investor interest in gold. And I think it was really because of other asset classes performing very well, things like tech stocks and Magnificent Seven stocks. I think they obviously diverted a lot of the attention away from gold amongst some investor groups, but that's a really good performance for gold. And I think the flows, we shouldn't be disappointed with that, because I think gold is going to continue to be quite strong in the next few years.
And the gold trust is the largest now in the Sprott family?
Yeah, it's our flagship fund. I mean, it's coming up to 15 years in age, and it's about 8.6 billion US dollars in size. It's one of the largest in the world, and we're incredibly proud of its success and all of the metal that we've been storing on behalf of thousands of investors around the world.
And silver also had a good run in 2024. It slightly outperformed gold. What were the flows like into the Sprott Physical Silver Trust?
Yeah, a little over 300 million US dollars came into the silver trust. I mean, the one thing about silver that everyone has been waiting for is for it to get back to its 2010 high. And we're still quite a bit away from reaching around $50 an ounce, right now sitting around 30. So we think there is still a lot of opportunity for that to reach its highs back in 2010.
Now, in spite of the moves that we saw in the underlying commodities, we really haven't seen a corresponding move in the equities. And if you look at Newmont, for example, the world's largest gold producer, it was actually down on the year. And if you look at Agnico, the third largest gold producer in the world, it was up about 30% on the year. Why do you think we're seeing such a huge disparity in terms of the performance of the equities, in spite of the move that we're seeing in the underlying commodity?
Yeah, it was a very mixed and challenging year for the gold equities. Some equities did reasonably well. Some of the smaller cap names in particularly did better than their larger cap counterparts. But as you said, some of the bellwether, the largest gold miners in the world, struggled last year. I mean, Newmont, obviously, and Barrick as well, underperformed gold quite significantly. And I think that's very confusing for a lot of investors, because the reason that you invest in gold stocks is for their operating leverage. As the price of gold goes up, you would expect a big chunk of that to flow down to their bottom line, and that clearly is not happening universally. Some of it is driven by operating challenges, cost overruns. Some of it is geopolitical reasons. In certain countries where mines are located, they're having challenges with local governments. Resource nationalism is on the rise. We're seeing that in parts of West Africa in particular, and that's obviously had a huge impact on the performance of some of those individual gold stocks last year.
And when you look at the buyers, the gold and silver products, how would you characterize those buyers? Are they institutional, retail?
It's everything. I mean, gold is really a universal asset class. And our funds being exchange traded are really accessible to just about any type of investor as long as they can access that particular exchange. We've seen growing institutional interest in our products in the last few years. That is a big change in the last 3 years, I would say. More and more investors, I think, are starting to realize the importance of having physical metals in their portfolios again after, largely ignoring them from, I'd say, 2011 to 2020. This is starting to come back. And it's important because when you look at how much exposure institutional investors have to precious metals, it's really tiny in aggregate. And many institutions have zero exposure. So it doesn't take a lot of capital to start shifting around for that to have an impact on flows and obviously the asset prices themselves.
Yes, and you raise a very good point. One of the things that I read recently was the amount of gold held by central banks. They've been big buyers in the last couple of years, consuming or acquiring 25% of global production, but all the gold held by central banks in the world only adds up to $3 trillion, which is the market cap of many tech stocks in the US right now. So I am surprised there hasn't been more interest, not only from central banks, but from institutional investors.
Yeah, I think 2024 was the year of the central bank buying gold. I think they had the single biggest impact on the gold price and the flows. It wasn't just China. Everyone talks about how China are basically recycling their US dollars and US treasuries into hard assets like gold. There's a very interesting chart you can look at in terms of looking at the holdings of US treasuries by the Chinese government and their holdings of gold. It's basically a mirror image, one going down, one going up. And we think that recycling trend is going to happen for a long time. And yes, China will try to talk the price of gold down when it gets a little bit too hot in its minds, but we think that that's not going to be effective and that they're going to be steady buyers of gold longer term. It's not just the Chinese central bank. We've seen the Indian central bank, the Turkish, the Singaporean, the Polish. They've all been buying large quantities of gold. And this is really, I think, part of a shift in their foreign exchange reserves. They're moving away from paper currencies and they're adding more hard currency, which is gold. And we think this is part of this kind of bipolarization of the world that's happening. Geopolitical risks are changing, and we think it's going to favor gold longer term. In sharp contrast, when you look at gold ETFs, which are a good barometer of institutional interest, they were in net outflows for the fourth consecutive year last year. So even though the price of gold has appreciated meaningfully last year, institutional investors, we think, were net sellers. So all you need to do is have some of that institutional buying power come back into the gold market, and you can have a very, I think, powerful set of buyers all moving in the right direction.
And you just mentioned that you think institutions were net sellers of gold. And we did see the price of gold fall off after the US election in November. Why do you think that was the case?
Yeah, well, leading up to the election, there was a lot of uncertainty in the market in terms of who was going to win. Everybody thought it was going to be very close. In the end, it didn't. And we think there was a lot of pre-election positioning, both in the futures market and the physical market, but mostly in the futures market. When the election outcome was concluded, we think a lot of that was unwound, and we saw some unwinding of those positions. There was also some euphoria that lifted stocks and cryptocurrencies around Trump's, pro-business stance, low taxes. But a little bit of that has kind of worn off, reality setting in. Now there's growing anxiety about trade wars, tariffs, currency depreciations, ballooning debt, deficits, interest payments. And I think you're starting to see gold, kind of reassert itself here a bit as people, I think, are viewing some of the geopolitical and macroeconomic risk factors in a different light.
You just touched on inflation, and Stanley Druckenmiller, a well-known U.S. investor, has said one of his biggest threats he sees in 2025 is a reacceleration of inflation. And one of the things he cited was lower taxes, higher tariffs, and he thinks that's going to be inflationary. What are your thoughts on that, and what will higher inflation or a reignition or a re-acceleration in inflation due to the price of gold?
Yeah, I mean, last year we obviously had the Federal Reserve cut interest rates a number of times on the back of inflation slowing down. And it's interesting that since the last interest rate cut, the US Treasury yield has gone nowhere but up, which is very counterintuitive. If the Fed is in an easing mode, why are longer term bond yields going up? And it's because the bond market is concerned about everything you just outlined. They want to be paid for what they believe will be higher inflation, whether that comes from the deficits that are out of control or tariffs and the inherent inflation that will import into the United States. The bond market is basically, I think, a pretty strong barometer of what expectations are. And now I think expectations are that the Fed is not going to be cutting as many times as previously thought in 2025. Higher interest rates are also very inflationary. If you think about things like mortgage interest and other consumer debt, if rates stay high, that's obviously not going to help inflation either.
And because the 10-year has moved quite high in the last few months, it's gone from a low of 360 up to 450, 460. The US dollar has also caught a bit, and this is negative for gold. But gold's been hanging in relatively well.
Yeah, I think you raise a really good point that in spite of higher treasury yields and a strong US dollar, gold has been very resilient. And I think it's because gold is simply reasserting itself as a financial and monetary asset. It's being sought by central banks around the world. It's also being sought by a number of investors around the world that are increasingly, I think, concerned about holding their own local currencies or assets. I think China's a really good case study. China is a country, obviously, of huge savers. And if you think about the types of options that Chinese investors have to put their capital into different asset classes, a lot of them don't look very attractive right now. The real estate market is going through a 2008 type of reset like we had in North America. Their stock market has been under pressure for years. And so that leaves gold. And that's something that they have a lot of history and affinity with. And we see continued buying by Chinese investors into gold products.
You just touched on China, second largest economy in the world, representing 20% of global GDP. So what happens there has a big impact on the rest of the world. It is definitely slowing down. Europe is slowing down. We still have pretty good growth in the US, growing at 2.5% to 3%. But if we get a slowdown in the US for whatever reason, what would this slowdown in the global economy mean to the gold price?
Yeah, I think it'll be resilient, because I think what will ultimately drive the gold price is the current scope of buying that we're seeing in the market, which is very central bank driven. And central banks are not as sensitive as investors in terms of the price of gold, meaning if they have a policy objective of X percent of their reserves in gold, they're just going to buy gold at whatever price until they reach that objective. So I think gold is more insulated against some of those shocks. But going back to your comment about China, it is weighing on, I think, a lot of investors today. And the Chinese economy, which for years grew at 7 or 8% per annum, now we're talking about 4 or 5% at most. And that is weighing on, I think, a lot of investor sentiment, because it is such a big economy and it is very important to a lot of different metals, given how many metals they consume and how many, the high percentage of metals that they obviously process in country. And I think that's had the greatest impact on metal markets in the last few months, this anxiety about whether the Chinese economy is going to shake off its situation. Government stimulus doesn't seem to be changing sentiment, and I think a lot of people are taking a wait-and-see approach there.
And John, maybe you can summarize for investors why they should own gold. Why should it be a part of their portfolio?
Yeah, I mean, we've been huge proponents of gold, obviously, at Sprott for many decades. And we view it as not a commodity, but as a financial asset, as an alternative currency. And we think it plays an important role in a portfolio in terms of acting as potential insurance or ballast to offset the risks of different asset classes like stocks. And one of the things you notice about bonds right now is it's not really playing that offsetting hedge right now with equities, because bond yields are going up, which means bond prices are going down. So we think that gold could be a more effective hedge than bonds right now, given the very high levels of debt and the growing anxiety about inflation right now. So it should be the cornerstone of a portfolio. It should be a strategic asset allocation. We don't think it's an asset that you should try to time. It should just sit there and accumulate, value over time, which is what it historically has done. And we haven't advocated to people to, put a huge amount of their portfolio into gold, but we think it should be a small part of your portfolio to complement the other more risky assets that you may own.
And Sprott has done a great job in creating a lot of resources for investors to learn about gold, silver, and various other metals. And if they want to access this information, where do they go?
Yeah, our website has a ton of content that our market strategists and portfolio managers write and blog about every month. We've got a great podcast. We bring in a lot of special guests, which are subject matter experts, and we're huge believers and proponents of investor education, which is why we do all these events and spend so much of our time, writing and talking to people. So I would encourage people to come to the website, go to our insight section, go to our blog section, and start your learning journey there.
John, thank you very much for telling us all about Sprott and its various gold and silver products.
Thanks for having me. It was great chatting.
Hi, I hope you're enjoying the conference. Just a reminder to subscribe to our channel, Bloor Street Capital, give us a like and leave a comment. Thanks for your support. Jamie, thank you very much for joining us today. How are things in Toronto?
Excellent. Snowy and chilly outside, as is appropriate for this time of year.
So Jamie, Agnico is the third largest gold producer in the world with 11 producing mines globally. But in the interest of time, I just want to highlight or touch on a couple of your larger ones, Detour and Malartic. And I want to start with Detour. It's Canada's largest producing gold mine. Average annual gold production is around 708,000 ounces. It has 19.7 million ounces of reserves, so this thing is massive. But you and your team have put forth a plan to increase production from 700,000 ounces to 1 million ounces. Maybe you can just touch on that and tell us how you're going to do that.
Yeah, that's exactly right. So we published a study update that really showcases the potential of Detour. So what we're envisioning is going underground and displacing lower grade 0.9 gram per ton material with over 2 gram per ton material. So the idea is that we'd ramp access the higher grade component of the underground resource and extract about 11,000 tons per day from underground. And couple that with the 70,000 tons per day that we're getting from the open pit. So you put it all together, it gets us up to about 1 million ounces a year. And based on the study, we stay at 1 million ounces a year for about 14 years. And it's, the potential of this asset is tremendous. The cost profile stays about the same. In fact, actually declines a bit. At a $2,300 gold price in those years that we're producing 1 million ounces a year, we're generating $1 billion a year of cash flow. So that's at $2,300 gold, obviously even higher at current prices. So it's a tremendous asset with great growth and exploration potential.
And what's the timeline associated with this plan? When will you get to 1 million ounces?
Yeah, so we're taking a very slow and steady approach to development. So what we published and announced in June was that over the course of the next 3 years, we'll be investing about $100 million. The idea is to get access underground, do some infill drilling, do some expansion drilling, conduct some bulk samples just to confirm grade continuity, make sure we understand the mineralization. So by 2027, we'd be in a position to pull the trigger on a full construction decision and start aggressively working through developing the mine underground. So that's the plan. The majority of that underground infrastructure will be complete by 2029, and then we expect to be at that 1 million ounce per year level by 2030. Again, with the potential to produce at 1 million ounces a year for 14 years. But the one thing that I always remind investors is that the study that we published, it was based on resources as at the end of 2023 that had a drill database cutoff of October 2023. So the underground resource at that time was 8 million ounces. Only 50% or 4 million ounces were actually included in the study. So, since that drill database cutoff, we've done a year and a quarter of drilling, we've added certainly to the resource base, and through some of the infill drilling that we've completed and that we will do, we think we'll be able to improve the mine plan even further. So I think that million ounce a year for 14 years, that's going to grow, and Detour will be at that 1 million ounce per year level for our potentially decades.
And what's the current mine life?
So the current mine life is actually out to 2052, based only on reserves. So you referenced it. We've got almost 20 million ounces in reserves at Detour. If you factor in resources, there's another 20 million ounces. So, if you add the reserves and resources together, this mine will be going for decades and decades.
Yeah, huge upside. So let's talk about your second largest mine, and that's Malartic, and it's also Canada's second largest gold mine. Expected production in 2024 is 630,000 ounces. It has 7.9 million ounces of reserves. And a big part of the Malartic story is one of growth associated with Odyssey. And you're currently transitioning from an open pit mine, which is what Malartic is, to an underground mine, which is what Odyssey is. Maybe you can just tell us how that whole transition plan is moving along.
Absolutely. So you're absolutely right. Up until a couple of years ago, Canadian Malartic was actually the largest open pit gold mine, and that title was overtaken by Detour. But Canadian Malartic will be transitioning from open pit, where we've been mining and milling at a rate of about 60,000 tons per day, at a relatively low grade of about 1 gram per ton. So that's historically what the operation's been running at. Between now and 2028, we'll be transitioning to underground mining at Odyssey at a rate of about 20,000 tons per day, but a grade that's 3 times the open pit grade. So we've got a third of the throughput, but 3 times the grade. What that means is that gold production stays effectively flat in around the 600,000 ounce per year level. But all of a sudden, we've got 40,000 tons of excess capacity. So that's a great problem to have. We'll be able to sustain production levels where they are, with tremendous optionality associated with that excess capacity.
There must be a good internal battle going on with the miners at Detour and the miners at Malartic about who's going to be the largest gold producer in Canada.
Absolutely. It's there's a race to 1 million ounces there for sure. And the Detour study in 2024 really showcased the potential of that asset. And some of what we've done more recently and what we'll work on this year will show a pathway to 1 million ounces of production at Canadian Malartic. We have a strategy that we call fill the mill. And that's filling that excess 40,000 tons of capacity. There's a few ways that we can do that. You might have seen we announced the acquisition of O3 Mining back in December before the holidays. And in so doing, with their Marban deposit, we see the potential to develop that as an open pit and feed about 15,000 tons per day to the Malartic mill. So that will help certainly fill part of the mill. Given the size and scale of the deposit underground at Odyssey, I mean, we've gone from, if you factor in reserves and resources, 0 to 16 million ounces over the course of the past 7 or 8 years, and growing. I mean, there's tremendous exploration potential and upside here. So we also see the potential for a second shaft. The first shaft underground project will give us that 20,000 tons per day. We could potentially see a second production shaft that would give us another 10,000 tons per day. So you put those 3 together, the first shaft, second shaft, and feeding 15,000 tons per day from the Marban deposit, and we're at about 1 million ounces a year. Beyond that, we have another satellite project called Wasamac. It's about 55 kilometers away. That's another project that has the potential to provide 3,000 to 4,000 tons per day of higher grade, 2.5 gram per ton material to the mill. So there's, as I said, a lot of optionality associated with that excess capacity. We actually have a plan between now and the early part of the next decade to fill the majority of that mill and get production from the Canadian Malartic complex up to north of 1 million ounces a year.
And you made mention of the shaft that's currently being constructed. How is that going?
Going very well. So I'd say we're about 2/3 of the way through that overall project, and including all the site infrastructure associated with it. where currently the shaft is down to a depth of over 900 meters. The project's progressing well. And again, that will support that transition from open pit to fully underground by the end of 2028, early 2029.
Jamie, another growth component of Agnico's growth strategy is growing the operations in Canada's north, and this includes Hope Bay, Meadowbank, and also Millodine. Maybe you can just tell us how those mines are performing.
Certainly. So we've got two operating mines currently in Nunavut, the Meadowbank complex and Meliadine. And 2024 was really a record year for both of those operations. A very strong focus on cost control and continuous improvement there. We've been hitting kind of quarterly operating and production records throughout the year, and will have achieved production of almost 900,000 ounces in Nunavut from those two operations this year, and generated cash flow well north of $750 million between the two of them. So it's been an excellent year in terms of operations in Nunavut. Now, Meadowbank has a mine life out to about 2028 currently. However, we do see the potential to extend that, though at a lower production rate, longer, potentially into the 2030s, again, depending on gold price. But the growth in our Nunavut platform is expected to come from our Hope Bay project. So Hope Bay was acquired from TMAC Resources back in 2021. You'll recall the Canadian government blocked the sale of that asset to a Chinese company at the time, and Agnico acquired it for about $280 million. The idea, the development scenario under TMAC was to operate it at a smaller scale. Agnico made the decision to shut it down and focus on exploration and really build up a critical mass in terms of mineable resource. And that's been the focus over the past several years. Given Agnico Eagle's experience mining in the north, we know that you need scale. You need to be at around 350, 400,000 ounces a year for an operation to really cover the fixed costs and generate strong returns and strong margins. So that was the target at Hope Bay, to see if we could get the mineable resources up to a point where it would support that kind of operation, where we'd be producing at those levels for a decade. And 2024 was a great year. We had this discovery in this Patch 7 zone of the proximate to the Madrid part of the deposit. And we've found higher grades and thicknesses that are amenable to mining kind of larger stopes. So we're excited. We think that's going to represent another mining front for us, and potentially help push that project beyond that 400,000 ounce per year threshold that we've been trying to achieve. So we'll be providing updates on Hope Bay throughout the course of this year. And we're working on a study that would support a redevelopment of Hope Bay, hopefully have that completed by the end of this year, early part of next year.
So I want to move on and discuss your balance sheet. And Agnico is producing a lot of free cash flow. And how will you allocate this cash flow in the coming year? Will you pay down debt? Will you pay dividends or implement buybacks?
Yeah, so we are in the very fortunate position right now that we can do a little bit of everything. We've done a great job through 2024 in terms of keeping a lid on costs. I always quote, the gold price went from $2,000 an ounce to $2,800 an ounce through 2024, a 40% increase. Our costs were up 3% year over year. So we've been able to deliver that margin expansion that investors in a gold mining company like Agnico would expect when prices are rising. So if you look in 2024, we paid a dividend about $800 million US. We bought back, up until the end of the third quarter, we bought back another $120 million in shares. So if you round up, almost $1 billion US of direct shareholder returns. In addition to that, we've substantially improved our financial position and strengthened our balance sheet. We went from 1.5 billion of net debt at the start of the year to approaching break even by the end of the year. So, between direct shareholder returns, the dividend and share repurchases, and what I like to call indirect shareholder returns, because we're strengthening the balance sheet, it was over $2.3 billion that went again directly or indirectly to shareholders in 2024. 2025 will be much of the same. We do have a significant tax bill in 2025. We are generating strong profits in Canada, and will be paying more in taxes than we did in 2024. But we still expect to generate very strong free cash flow. We still expect to be able to pay high dividend, buy back stock, and reinvest in the business. We're looking at increasing our capital spending and increasing our investment in exploration. So again, at these gold prices, fortunate to be able to do a little bit of everything.
The government always has to get their cut.
They sure do. It's a certainty in life.
So you just touched on exploration. What is your budget?
So our budget for 2024 was around 300 million. And I'd expect, we haven't released formal guidance with respect to 2025 yet, but I expect it'll be a bit higher than that, especially when you factor in some of the spending on, for example, Detour Underground. A lot of that infill and expansion drilling that we're doing, the pace of that will be accelerated. We also put out a study in July of 2024 on our Upper Beaver project in Kirkland Lake. And we'll be spending doing additional drilling on that as well. So you expect an expanded exploration budget in 2025.
So Agnico has done a very good job of creating value through the drill bit, but also by way of acquisition. You touched on earlier that you're in the process of acquiring O3 Mining, and you've acquired many small exploration companies and development companies over the years. But is this a strategy that Agnico is going to continue on with in the coming years?
Yeah, I'd say if you look back in Agnico's history, further back, the focus from an M&A perspective was more on earlier stage, smaller scale operations where Agnico could add value through the drill bit by ultimately developing and expanding mines. I'd say, over the past 3 or 4 years, the focus has been more on larger scale strategic M&A. So, for example, the merger with Kirkland Lake in 2022, the consolidation of 100% interest in Canadian Malartic in 2023. I mean, those really solidified Agnico's position in our key operating jurisdictions within Canada. So Ontario, Quebec, and I guess TMAC in Nunavut. So it set up the company extraordinarily well. I mean, our strategy is regional consolidation to create a competitive advantage. We believe that by being, the biggest employer in the region, by having the strongest supplier and First Nations and community relationships, that provides a tremendous competitive advantage that allows us to run our mines as efficiently as possible and keep our costs as low as possible. So I'd expect more of the same. I mean, O3 was a bit of a smaller transaction, but it's right down the middle of the fairway in terms of leveraging existing infrastructure to create a very high return for our shareholders. So expect that'll continue to be the focus going forward.
And it's just not Agnico that's been making sizable acquisitions here in the last few years. Newmont, for example, acquired Newcrest. But do you think this is going to be an ongoing trend within the industry?
Yeah, I think, M&A will certainly continue. There has been a lot of consolidation in the industry over the course of the past 10 to 15 years. You go back a decade or more, and that's all investment bankers would talk about, is the need for consolidation amongst the intermediate or mid-tier producers. A lot of that's happened. And I think, Agnico Eagle's in the luxurious position now of not really needing to do anything. We've got 6 organic growth projects. If you factor in Shaft 1 at Odyssey, a potential Shaft 2, our Detour Underground expansion, the Upper Beaver mine in Kirkland Lake, our San Nicolas project in Mexico, and Hope Bay and Nunavut. So there's a lot going on within the existing portfolio, which means we really don't need to do anything. And with long life mines like Detour and Canadian Malartic that are going to go at north of 1 million ounces for decades, it provides a really strong foundation for the company going forward. So we have the again the luxury of being able to be patient, not needing to do anything, and we can evaluate external opportunities against the 6 high return projects that we have within our own portfolio.
And Agnico has 11 producing mines. A few of them are quite small, but would you ever consider selling off some of the smaller producing mines to focus more on the larger ones like Detour and like Malartic?
Yeah, so I think our smaller operations all are unique and make sense within the portfolio for different reasons. If you look at our Mexican operations, we're really transitioning focus there to the San Nicolas joint venture that we have with Teck. Our La India mine was effectively closed last year. The Pinos Altos mine has a few years remaining, but we're dedicating a lot of our technical resources and management to the San Nicolas project, which we see as having a lot of potential. So that project in Mexico certainly remains core for Agnico. If you look at our Kittilä mine in Finland, that's an operation that is steady state currently, producing about 220,000 ounces a year, generating almost 200 million a year in cash flow, and all of the infrastructure has been bought and paid for. So it's really paying a healthy dividend every year with no significant additional capital required. And there's the potential in Finland for that to become a bit of a regional hub. There's a lot of early stage exploration companies with interesting projects that are within a trucking distance of the Kittilä processing facility. So that's a potential consideration there. And if we think about our Fosterville mine in Australia, you'll recall Fosterville had the super ultra high grade Swan Zone, and for a period of time was one of the largest taxpayers in Australia, just given the level of production and cash flow that was generated from that operation. Well, there we're focused on exploring to try to find another Swan Zone. We think that there's a lot of remaining exploration upside there, and the mine's more than paying for itself. It's in 2024 generated on average $1 million a day of free cash flow. So it's supporting not only continued capital investment, but the exploration effort there, and still generating a dividend beyond that.
Agnico has a lot going for it right now. As you've already mentioned, you're generating millions of dollars of free cash flow. You're returning cash to shareholders in the form of dividends and also buybacks. The 75% of your production comes from Canada, one of the safest mining jurisdictions in the world. And I'm just kind of curious, with all these benefits or positives, are you getting a lot more calls from generalist investors?
We are absolutely starting to see more interest from the generalist investor, which is what we want. I mean, we talk about Agnico Eagle. It's a great company, not just a great gold company, and we're hitting some of the return metrics and kind of free cash flow yield thresholds that generalist investors would expect from a company in any industry. So I think we're becoming increasingly attractive to the generalist investor, and I think gold has a role to play in any investment portfolio. And frankly, it's a sector that's underinvested in currently by the generalist investors. So there's lots of opportunity and potential there. We are focusing our marketing efforts on trying to meet with new sources of capital, and trying to introduce the company to those that we haven't met with before. We've seen specialist resource funds really shrink in size over the past decade or so, and so I think for the industry we need to work to appeal and showcase the value creation potential in our companies to more generalist investors.
And when you said you're getting more interest from generalist investors, are they coming out of the US or Europe or where?
I'd say the combination of both. We are trying to get off the beaten path a little bit in terms of not, just attending the same conferences and seeing the same faces and going to different cities and meeting with, high net worth individuals and family offices that perhaps we haven't met with before. But I'd say we're seeing an uptick in generalist investor interest across the board, whether it be in Europe or North America.
Jamie, as we wrap up, what can investors expect in terms of news flow in the coming months from Agnico?
Yeah, so I think the focus in 2025 will be more of the same. Quarterly updates on the 6 development projects that I referenced. I think there's going to be a lot of focus internally this year on the second shaft at Odyssey, and we'll be in a position to release something publicly on that hopefully around this time next year. Similarly, there's a lot of effort underway currently at Hope Bay to complete that study, and again around this time next year we'll be in a position to publish that. But as we work through the year, we're doing a lot of very exciting exploration work. We're investing significantly in expanding resources at our biggest projects, so we'll be able to provide updates on that. And I envision, being able to continue to report strong production results and ensure that we continue to achieve our guidance with respect to costs and capital spending, so that we can ultimately deliver that free cash flow that the shareholders expect.
Well, Jamie, that was a great update, and I want to thank you very much for spending time with us today and sharing the Agnico story.
Thank you for having me.
Paul, thank you very much for joining us today. You've been the CEO of Centerra Gold now for a year and a half. And when you first started, you released a strategic plan which would focus on maximizing the value of the various assets in your portfolio. Can you just provide us with a brief overview of what that plan was and how things are progressing?
Well, Jimmy, thank you very much for having me here. It's always a pleasure to get together and reach out to some of our investors and would-be investors. Centerra, we have a number of assets, principally in the Americas, but also in Turkey. And the focus over the last year and year and a half really has been to demonstrate and communicate to the market, our shareholders, our stakeholders, the value that we see in each of our assets. It was our view a year and a half ago that all of the assets in the portfolio were not recognized for having the value that we think that they have. And through some good work on the commercial side, on the technical side, on the operating side, we believe we're starting to demonstrate the value that each of our assets has over and above what the market has given us credit for. And I'd say we started with Mount Milligan. It's our flagship asset. It has the potential for a very long life here in British Columbia. And we started with a renegotiation of the stream with our partner Royal Gold. And since then, we've launched into a technical program to extend the mine life, further exploration. We've also put out some news on our molybdenum assets. We're proceeding with the reopening of the Thompson Creek mine in Idaho. And we're also doing work in our project pipeline at Goldfield in Nevada and Chemes in British Columbia.
So let's look at some of these assets in a little more detail. And I want to start with Mount Milligan, which is a gold copper mine located in the province of British Columbia. Can you just provide us with a brief overview on how things are performing at Mount Milligan?
Yeah, so let me give a quick overview of what the asset is. It's a very large copper gold porphyry deposit, the type of which is fairly common in British Columbia. It is a large, it's really a copper flotation plant that was built just about 10 years ago. And we believe this asset has the potential for decades of production. We currently have a reserve on the books that sees production until 2035, but we see significant longevity beyond then. This is the deal that I alluded to earlier with Royal Gold. Approximately a year ago, we announced that we had come to a new agreement with Royal Gold, an additional streaming arrangement whereby the terms of the stream improve for Centerra in 2 steps, one roughly occurring in 2030 and the second occurring in 2035. This improvement in terms for Centerra has given us the confidence to invest in drilling and technical studies. So first out of the gate, it gave us a mine life to 2035. And we've got about 250 million tons of ore delineated that will support that mine life. But importantly, in addition to that, we have another 260 million tons, give or take 10 years at current throughput rates, that we could bring into the mine plan. And that amended stream is what gave us the incentive to advance studies there. So we are midstream right now on an engineering study that is looking at how do we add 7, 8, 9, 10 years of mine life in addition to the current 2035 that we have. And so what we're looking at is how do we create an optimized mine plan that brings those extra years into production? How do we potentially look at throughput enhancements in the process plant? How do we look at expansions to the tailings? And all of these things are part of the study that we are currently carrying out. So our immediate goal, and we're going to be putting out a study later this year, we intend, or our objective is to show a significant increase in mine life beyond 2035 at Mount Milligan. Now, it doesn't end there. We've also ramped up our exploration plans. We are doing drilling. We have continuity of mineralization to the west and to the south. And we believe that beyond the study that we're working on, there will be continued potential for expansion even beyond the scope of that study. So we're very excited about what we see at Mount Milligan. And it is a very large copper gold mine in British Columbia, in Canada. And these assets are pretty rare these days. And you've seen transactions in the market where assets in places like Canada are highly sought after and richly valued. One other thing I should say about Mount Milligan is it's typical of these large throughput, low-grade operations that it takes a number of years to really dial them in, getting them humming operationally. And over the past year, we've also invested a fair amount of effort in improving our operating performance, in becoming more productive in the mine, in the process plant, looking at our cost structure, how we do procurement. And I'm happy to say we've made a number of significant gains in improving our productivity. You've seen lower per ton processing costs. We're optimizing our load haul cycles in the mine. We're managing our concentrates better to drive better recoveries. And this is a process that will continue through 2025 and into 2026. But we are, in addition to looking at longevity in the mine, we're really focused on operational full potential in our day-to-day, month-to-month, and annual operations.
You provided a lot of detail there, and I want to thank you for that. But you made mention of the fact that this study is going to come out later in the year. Is that in the first half or the back half?
We currently are talking about in the middle of the year for a PEA, but some of our work has advanced better than expected. So we might upgrade the scale of that study. And if we did so, it might be a couple months after mid-year, but it'll be in the middle part of the year, summer to late summer, that we put out some news on the potential of Mount Milligan.
So I want to move on now and discuss another asset, and that's Öksüt, which is a gold mine located in the country of Turkey. Maybe you can just give us an update of how things are progressing there.
Yeah, so some people may know that the mine was a couple of years ago shut down to an environmental exceedance. One of the first orders of business about a year and a half ago was to get that mine reopened, which we did successfully. And since then, it has generated very significant cash flow, in part because we're drawing down accumulated inventories. But it is a low-cost, very straightforward heap leach mine. It's located in central Turkey, and we have mine life out till 2029 on the books. And we continue to expect low-cost, high cash flow in the remaining years of Öksüt. One other thing I should say is Turkey is a fabulous place to operate. The mine has generated a lot of cash, as I said, for Centerra. And we are interested in continued presence in Turkey, and we are active on the exploration side.
And because I was going to ask you, because the mine life is so short, 2029, can you do any more exploration there? Is the hope that this mine life might be extended, or would you consider pursuing other assets within the country of Turkey?
It's most likely in the latter scenario. We are doing some exploration and near mine drilling at Öksüt, and I don't think there's going to be a significant expansion there. There might be 1 or 2 years of incremental production, but it won't be significant. We are more focused on greenfields drilling. We're active at 4 different sites throughout the country, and we're always on the lookout for commercial partnerships, something to extend our presence in Turkey. We believe that we have a great operating team on the ground, and we would love to be able to leverage that into another asset in the country. Turkey has great geology, lots of prospectivity, the talent levels, the skill levels of the various trades, the technical skill set is very strong. Permitting is robust and predictable. And we just think it's a great place to operate and would love to do more in country.
So I want to move on now and talk about some of your moly assets. And you restarted construction at a Thompson Creek mine, which is located in the state of Idaho. How are things progressing with this startup?
Right. So a quick overview on our molybdenum assets. We have three moly assets. We have two mines that had been on care and maintenance in Daco in British Columbia and Thompson Creek in Idaho. And as you alluded to, we recently approved proceeding with a reopening of the Thompson Creek mine. Our third asset is a metallurgical facility located just outside Pittsburgh, and that has been running at 1/3 capacity on third-party material over the last decade. The business plan here is to reopen the mine, produce our own molybdenum concentrate, ship it to Pittsburgh, blend it with third-party material, and drive returns not only at the mine level, taking advantage of a robust molybdenum price environment, but also driving strong cash flow potential at the roaster by blending our own materials from Thompson Creek with third-party material. So in short, we're investing $400 million to restart the mine and ramp up capacity at our Pittsburgh facility to near 100%. We're off to a good start. We're 4 or 5 months into the project and so far tracking on budget and on time.
Now, you previously talked about running a strategic process on the U.S. moly assets, which would include selling both Thompson Creek and also Langeloth Met facility. How's that process progressing?
Yeah, so I suppose the key message here is that the molybdenum assets are sometimes perceived as an odd fit within a gold mining company like Centerra, and we are a gold mining company. We intend to remain a gold mining company. We have these assets in the portfolio, and our view is that they have significant value. Our study showed $472 million of NPV using an 8% discount rate. So these are valuable assets, but I would say they are non-core, and that's the strategic process that you alluded to. We would be open to selling the molybdenum assets in whole or in part, but we want to recognize value for them. And in other words, we're not just going to give them away. So we are open. We have a process running in the background. And the important part was to get a study into the market, which we did, and to greenlight the project, which we did. And we can now talk to potential parties who are interested in those assets. There's nothing immediately that I can talk about, but I think that the key point is that we would be open to a transaction that surfaces value for our shareholders, but at the same time, we won't just give them away because we see real value in these molybdenum assets.
And you said you would consider a partner, but your preference is to sell.
I think we'd be okay with either. We'd be okay either with an outright sale or bringing in a joint venture partner to essentially lessen the capital exposure risk for Centerra. So either outcome could happen. So for example, on a joint venture, one might think of a private equity type partner who doesn't want to be the operator but wants exposure to molybdenum. That's one example where a joint venture might be preferable to an outright sale. Another point I should make on our molybdenum assets, as I said, we're investing $400 million into the reopening of Thompson Creek. Largely speaking, we will be able to fund that out of ongoing cash flow. In other words, we don't really materially need to dip into our very strong balance sheet. We have $600 million in the bank right now. We really don't need to dip into that in any material way to fund the reopening of Thompson Creek. And I think that's an important point because sometimes the concern is, well, Centerra has $600 million and a big chunk of that is going to go into moly assets. That's simply not the case. We will fund that project largely out of operating cash flows from Mount Milligan and Öksüt.
And do you have a timeline associated with this process?
No, the strategic process, no. Molybdenum assets are not, as you might imagine, particularly liquid in the market. And I think it's going to be more of a bespoke type situation where we'll be opportunistic if something shows up. The other point I'll say is that we expect first production from Thompson Creek in 2027. And of course, the closer we get to that production, the more attractive the assets will become because the capex will be sunk and it'll be more obviously a going concern. So from a certain point of view, when you look at the life cycle of projects, you're almost at a valuation. The greatest valuation discount is when you first start spending. So to the point of not being in a hurry on the strategic process, we'd like to actually put some capex into it to then de-risk the project and re-rate its value upward. So of course, I can't predict, I can't speculate on M&A, but we are patient and we want to recognize full value for these assets.
And you mentioned you're going to put 400 million into it, and I think you mentioned this, but what was the ballpark number? What do you think these assets are worth?
Well, we in our study, we had 472 million of NPV using an 8% discount rate. So that's our value marker that's out there. I think that one of our challenges on valuation, we think we're very cheap. We think we trade at a very low PNAV, and we often get asked the question, well, given your cash in the bank, given your profile, your free cash flow generation, why do you trade at such a discount? And I think that there are several potential ways to look at this, but I think principally it's the molybdenum assets because we don't get credit for the moly assets because people buy us for gold and potentially copper exposure as well. So I think the moly assets are in some way the greatest source of our value disconnect. And if there were to be an exit or a monetization or a partial monetization, I think that will go a significant way to re-rate us and remove some of the discount that exists in the stock. Now, I suppose part of the flip side of that valuation problem is we have 600 million of cash, and this is a market bullish for gold that does not reward a lot of cash in the bank. The market wants to see that cash deployed into gold production or gold development, and that allows me to segue into another broader part of our strategy. Our growth focus is in gold, so we are always on the lookout for acquisitions either of producing assets, but we're also not averse to buying things that are later in the development stage, that are near production, where our cash would make sense to finish off the asset and bring it into production. But I suppose the point I want to communicate there is we are very active on the strategic front, looking for acquisitions. Now, as I said, as everybody knows, it's a bullish environment for gold right now, and so valuations are stretched. We're definitely looking for growth in gold, but it's not growth at all costs.
And you mentioned that you would look at either a producer or a late stage developer. What jurisdictions would you look at?
Well, we certainly, as some people may know, the history of Centerra was Kumtor, the mine in Kyrgyzstan, one of the richest gold mines in the world, and everybody knows about the exit of Centerra from Kyrgyzstan. And during that time period, over the last 3, 4, 5 years, the company strategically pivoted away from jurisdictions such as Kyrgyzstan, making acquisitions in British Columbia, Nevada. And I think we are now seen as a company that operates in safe, quote unquote, jurisdictions. We're British Columbia, we're Turkey, we're Nevada. And so when we look at our acquisition strategy, we are obviously biased to the places where we already operate. I already talked about Turkey being a very attractive place to invest. Certainly that's something we'd continue to look at. But of course, Canada, the US, the places where we operate. And I'd say that we would be open to acquisitions in countries that have similar risk profiles to where we already operate. So for example, there might be a couple countries in South America, perhaps in the Balkans, that match that risk profile that we currently have.
Okay, so you mentioned Nevada, and let's talk about your development projects that you have in your pipeline. Goldfield in Nevada and also Chemist in British Columbia. Can you just talk about what your plans are for these projects and how they might contribute to future growth?
Yeah, so let me start with Chemist. It's the more substantial asset. We have nearly 4.5 million ounces of gold in resource there, and we have approximately 1.7 billion pounds of copper. So it's a very large deposit, similar to Mount Milligan, a big copper gold porphyry. It is also a past producer. It operated for over a decade with very good cash flow when it ran. And so it has all the infrastructure in place. It has a process plant, it has an airstrip, it has a camp, it has associated facilities, it has a power line, it has water. The replacement value of that infrastructure in this market is $2 to $3 billion to build that scale of mine. And I should add that many of the permits are in place, as well as agreements with First Nations in the area. So what we are looking at is there a more capital efficient way than was previously conceived to develop a project there? And so what we're working on right now is almost starting from the ground up, looking at the geology, looking at our resource model, putting together a more site-wide holistic resource model to see if there is a more capital efficient mine plan that we could bring into play. There would, of course, be some capital associated with refurbishing the equipment, the infrastructure, the plant that I described. But compared to a greenfield build, it would be much, much lower cost. Another point of historical context, Centerra had initially thought of developing a block cave concept at Chemes, and we view that as simply too capital intensive and too long a development timeline. In other words, too much risk in CapEx and development timeline, which is why we are doing a refreshed look at it. We have begun a study, and while we haven't communicated it formally, we anticipate putting out some sort of study by the end of this year, the end of 2025, to give a perspective on what a path forward might look like for Chemes. But certainly in the current commodity price environment, both gold and copper are in very, very bullish parts of their cycle. An asset the size of Chemes, I think, could be an attractive component of our growth portfolio. So let me go to Goldfield. It's an acquisition that Centerra made coming up on 3 years ago now, I suppose. And the acquisition was predicated on a oxide and sulfide project. We did a pivot last year. We didn't think that was the right approach. So we are focused on an oxide-only heap leach, very simple flow sheet, very low CapEx. So our next step is to put out a resource on the deposit, and we intend to do that with our year-end figures here next month. So that'll be the next step on Goldfield, is an initial resource, and then we will outline a potential path forward. And that could include more study, more drilling, or we might pause it for a while. It'll depend on the size of the resource. I don't want to get ahead of myself here, but we'll put that out with our year-end news, like I said, next month.
So let's talk about your balance sheet. You already mentioned that you have $600 million in cash. A lot of other gold miners out there are quite envious of that fact. But how will you allocate this cash in the coming year? Will you focus on buybacks, dividends?
We've been very active on both the dividend and the buyback. We returned a significant amount of money to shareholders through both the dividend and the buyback over the last 18 months. We will continue the buyback. We were on the pace of just over 40 million last year. We intend to continue at that pace roughly. We'll continue to pay our dividend. We like to say that we have one of the highest yields among our gold mining peers, but we don't want to brag too much about that because a low yield just implies a low share price. We'd like to get our share price up, but the point is we pay a good dividend, and we have a robust buyback program. We intend to continue both of those. In terms of other areas where we will invest our money, as I said, we are investing in exploration. We have greenfields projects, 4 of them in Turkey. We have a number of agreements with juniors in Ontario, in British Columbia, in Nevada as well, where we're active on greenfields programs. I said we're also doing the Thompson Creek project. That's part of the use of cash, but as I said, that will be largely funded out of ongoing operating cash flow. So the question then is, okay, you're paying a dividend, you're doing a buyback, you're doing exploration, you're funding Thompson Creek without materially dipping into the cash balance. Well, what else are you going to do? And this goes back to what I said, is that we are acquisitive. We want to make an acquisition where we can put that cash to work in a gold and maybe copper, but principally a gold type asset.
Paul, as we wrap up, maybe you can just summarize for some of the events investors should be looking for in the coming months.
Well, I think what I would begin with is the overarching story here is we think we're very cheap. We think we trade at a very low multiple. Whether you take the consensus multiple or our own view, we think we trade at a very low multiple. And we need to continue to deliver on our strategy, which is daylighting the value in our assets. So the milestones, the things that you refer to there, will involve, of course, our year-end numbers, which will have in there the resource number for Goldfield, but also we will clarify the scope of studies for Mount Milligan, as I hinted to earlier. We're likely going to upgrade the quality of the study because we're very pleased with the progress we've been making there. And then, of course, there will be the actual study, which we release somewhere mid-year on Mount Milligan, which is the first step in delineating a much longer mine life. As I said, on Chemes, we're probably going to put out a study towards the end of the year. So these are the main project level milestones, something on Goldfield in February, something on Mount Milligan in the middle of the year, mid to 2/3 of the year, and then something on Chemes at the end of the year. And then, of course, along the way, construction milestones, progress milestones at Thompson Creek, milestones on ramping up capacity at Langeloth, which we are actively focused on, and hopefully some good exploration results along the way at Mount Milligan or on some of our greenfields joint ventures.
Well, it sounds like you and your team are going to be very busy in the coming months, and I want to thank you very much for spending time with us today.
Thank you, Jimmy. It's always a pleasure, and we'll see you around.
Hi, David. Thank you very much for joining us today. How are things in Vancouver?
Everything's great. Thanks very much.
So I love that city, by the way. I got to get out there soon. But for those who aren't familiar with Gold Royalty, why don't you provide a quick overview of the company?
Sure. Gold Royalty Corp is a diversified royalty company focused on precious metals. Over 90% of our exposure is in gold. We have over 240 royalty portfolio. 8 of them are cash flowing. We have another 14 in various stages of development. And this year is an inflection year for us. We've gone from startup, we only IPO'd about 3.5 years ago, now to positive operating cash flow in 2024 and positive free cash flow in 2025, and about 60% compounded annual growth in our revenue right through the end of the decade. From some of the largest scale operating mines in North America, we have royalties in 3 of the 5 biggest producing gold mines in North America, including Canadian Malartic, Côté, and also the underground extension of Goldstrike, the Ren deposit.
And as you mentioned, you have over 200 royalties, and I want to touch on some of the larger ones that you mentioned, and that's what's going to be driving growth here in the coming years. But I want to start with Canadian Malartic. This is Canada's largest gold mine. It's located in the province of Quebec. Why don't you give us an update of this asset and what it means to Gold Royalty?
Well, my old company, Agnico Eagle, is undertaking a $1.6 billion expansion of Canadian Malartic, exploiting the underground Odyssey mine, bringing it into production over the coming years, initially from a ramp, but they're putting a permanent shaft in place, and will be fully converting it from an open pit operation to an underground operation from Odyssey by 2028. And we have significantly more royalty coverage on the underground portion on Odyssey than we do in the open pit. We have limited coverage on the open pit. We're getting about a couple $1 million of revenue currently from the open pit operation, but as we go underground, we're going to see a multiple fold increase in our royalty coverage and our royalty revenue as they convert entirely to an underground operation. And that project's well advanced. In fact, it's a little bit ahead of schedule. And the other opportunity we see there is as they get production setups, they're also going to get underground exploration setups, which will intensify the exploration drilling on that deposit and likely convert significant amounts of resource into reserve, but also look at step-out drilling, which could add appreciably to the resource profile there and to our royalty coverage on the underground operation at Odyssey.
So there's huge upside there. When will this transition from the open pit to the underground take place?
Well, it's happening on an incremental basis initially. They are producing from underground from the ramp, but they are putting a permanent shaft in place, which will allow it to convert fully to an underground operation, we believe, by 2028. And they're also talking about a second means of access, a second shaft on the project, because the resource has grown so substantially. They're likely to require an additional means of access to ramp up the production rate because they're going to have spare capacity in their milling complex. They're mining and milling right now from the open pit close to 60,000 tons a day. When they convert to an underground operation from a singular shaft, they're going to ramp down to 19,000 tons a day of much higher grade mineralization. That means about 40,000 tons a day of spare capacity in the mill. So as you can imagine, Agnico's placed a priority in finding other sources of ore from Odyssey through other means of access like a second shaft and looking for some near surface deposits as well to fill a very hungry mill.
It's amazing the growth that Malartic has achieved over the last 5 or 10 years. It just keeps going.
It does, and this underground is really down the middle of the fairway for Agnico Eagle. They've been in that district since the 1950s, primarily mining from underground. So that's their core competency, if you will. So as they're getting underground, they're leveraging all that expertise they built up at LaRonde, at Goldex, at Lapa, the other mines they've exploited and built over multiple decades. And so they have the expertise, and now that they've consolidated ownership, they can accelerate not only the development of the project, but as true to their character, they accelerate their exploration as well. They put as much effort in their exploration as they gain access for production as they do the production itself. They're always looking for ways to grow their deposits and add potential expansion opportunities within their significant existing industrial complex.
So let's discuss IAMGOLD's Côté Gold project now. That's located in the province of Ontario, and when it's up and running in full production, it's going to be Canada's second largest gold mine. Tell us about this asset.
Sure. Well, we acquired a royalty on it, 0.75% NSR royalty on Zone 5, which is the highest grade portion at the southern end of the pit. And IAMGOLD's completed construction of this project. In Q2, we actually got our first royalty payment, and they achieved commercial production in August, a month ahead of schedule, and are expected to achieve 90% of nameplate capacity in the mill by the fourth quarter. They've stockpiled about 5 million tons of ore on surface, which is sufficient for 6 months of production. So in a great position to ramp up production quite rapidly. And we expect to have quite a significant kick up in our royalty revenue in the fourth quarter. For them to achieve their production guidance this year from Côté, they're going to have to hit that high grade zone where we have a 0.75% NSR quite hard in the fourth quarter. So we do expect significant growth from Côté, not only in the fourth quarter, but as they achieve a full year of full-scale production over the course of 2025, we expect a significant leg up in our royalty revenue in 2025. So that's a significant component of our growth going into the new year.
And I just want to provide a little more context for our viewers, just how large this mine is. In the first 6 years of production, it's going to produce 495,000 ounces annually, which is quite large. And it also has a very long mine life. It's going to produce until 2041.
That's right. And I would say that's a recurring theme within our portfolio. As I mentioned earlier on, we have royalties in 3 of the 5 biggest producing gold mines in North America. So not only do we have this vast, diversified portfolio of over 240 royalties, but we have some cornerstone foundational assets that are going to be producing annuities for us for decades to come. And I think that's a distinguishing feature of our portfolio relative to many of our smaller cap peers in the space, is we do have assets that are chunky, long life in some of the best jurisdictions in the world, with a heavy concentration in Nevada, Quebec, and Ontario within our royalty portfolio.
It's all about jurisdiction when it comes to mining.
It is. At the end of the day, a royalty company is a collection of contracts, and you have to make sure that you have contracts in jurisdictions that have rule of law, that have a judicial framework around protecting the sanctity of those contracts, as has been clearly demonstrated by some of the larger cap peers in our space who've had difficulty enforcing their royalty or streaming contracts in some more difficult jurisdictions.
Another asset I want to touch on is Vareš, and that's located in the country of Bosnia. And this one's a little bit different because it's a copper stream. Can you tell us about it?
Yeah, sure. Adriatic Metals out of Australia, it's a $1 billion plus market cap company, built this newest operation earlier this year. It's in production currently, expected to be in full production this quarter, in the fourth quarter, as we speak right now. We've already actually started to get our first copper stream. It's a very large zinc silver mine with 18 years of reserve life, significant exploration upside. And Adriatic's already discussed a expansion of that operation next year once they achieve commercial production. Of course, within our royalty streaming contract, it's fully paid for. We get the benefit of that upside, both from an exploration expansion standpoint, without actually having to contribute anything to it. And that's true across our entire royalty portfolio of over 240 royalties. Every one of them are bought and paid for. We have no capital calls. We're not exposed to any capital cost risk or operating cost risk. It's all top line exposure. So we get the benefit of the upside of these assets as they ramp up, get expanded, and get explored, and we get the benefit of the exploration upside to the efforts of our operating partners.
David, just one more asset I want to touch on, and that's Aura's Borborema, which is located in the country of Brazil. It's 60% complete. How's the construction going, and when do you expect production?
It's going exceedingly well. In fact, we are getting pre-production royalty payments as part of the unique structure we put in place to help finance the construction of that mine. We're not only getting pre-production royalty payments, but we also have a gold-linked convertible note as part of the financing structure. So we're getting interest in the form of ounces. So we're getting at least a couple $1 million of revenue this year from Borborema, even though it's still under construction. As it achieves commercial production over the course of 2025, we're going to see another significant leg of royalty revenue growth in the new year as well. So that's an important source of our growth in 2025 that will deliver positive free cash flow for the company.
And I don't think I've ever heard of pre-production royalty payments before. Is this something that's very unique within the industry?
Well, I think it's unique to our structure, and we had a very unique financing structure in that we provided $31 million of financing towards the construction of Borborema. 20 of it came in the form of straight NSR, 2% net smelter return royalty that we're getting some pre-production royalty payments on that'll be creditable against future royalty payments as it ramps up into production. But also $11 million of that $31 million was a cold link convertible note that gets paid interest in the form of ounces. So we're getting gold exposure even as the project's under construction. And Aura was in a position to do that because they're a diversified producer. They have two other producing mines, and they provided not only cash flow during the construction phase to us, but a corporate guarantee over the life of the mine.
I want to move on now and discuss your balance sheet. A large part of your strategy is growth through acquisition, so liquidity is very important. So maybe you can just tell us about your balance sheet and where you stand in terms of liquidity.
Sure, we have a revolving credit facility with Bank of Montreal and National Bank Financial, and we still have of that $35 million facility, we have still 10 available. We have several million dollars of cash on the balance sheet as well. Otherwise, we're substantially unlevered. In fact, with the cash flow picking up in the new year with positive free cash flow, we expect we'll pay back some of that revolver and maintain that availability so that we have cash that we can deploy to new royalty opportunities over the course of 2025. So we're in a great position. And we've been able to demonstrate that when we need capital, we can raise it. We've deployed $90 million of capital in the last year on several cash flowing royalties, namely Borborema. As I mentioned earlier on, we also acquired a royalty on Varus or a stream on Varus, but also we bought from a third party the Cozamin royalty, which is Capstone's copper silver mine in Mexico. So we've been able to acquire massively cash flow per share accretive opportunities over the course of last year with $90 million in new capital that we've been able to raise through various sources. So we've been able to demonstrate when we see accretive opportunities, both on a net asset value and cash flow per share accretive basis, that we will be able to raise capital through very strategic sources that we've been able to attract since our inception in 2021.
One thing that really stands out to me about Gold Royalty is that you're trading at a deep discount to many of your comps. Why is that, and what will you and your team do in the coming year to close that valuation gap?
Well, I think it's the same stigma that unfortunately many of the smaller cap players in the gold universe have suffered over the last several years. Growth is a dirty word. And we've had by far the best growth profile among all of the royalty players. I'm not just talking about the small cap peers. I'm talking across the entire royalty universe. We are by far the largest growing or the quickest growing royalty company with 60% compounded annual growth in revenue to the end of the decade. And that growth has been severely discounted. We think unjustifiably so because the operators that are building out that growth are well capitalized. So the Agnico Eagles of the world, Newmonts, Ore Minerals, IAMGOLDs, all well-capitalized operators that delivered, and Adriatic Metals as well, a well-capitalized operator out of Australia. They have the balance sheet and the technical capacity to optimize those assets, expand them, explore them. And the market, unfortunately, is discounting them as if they're run by juniors. But I think in the fullness of time, as we crystallize that growth, and again, all that growth is paid for, all we have to do is harvest it, wait for it to come in, collect the checks, if you will. We think the market will start to deliver a significant re-rating of our share price beyond what we've experienced up to this point.
And David, as we look out to 2025, where do you see the biggest growth opportunities within your portfolio? And maybe it's with a specific asset, maybe it's in a certain jurisdiction.
Look, Borborema's ramping up in 2025. That's going to be a significant source of growth. Côté is going to be delivering its first full year of production in 2025. Again, a significant source of growth for us. Varus, again, only just started production this quarter and will be delivering a full year of production. So we have three chunky long life assets that are going to be delivering substantial sources of growth in our revenue in 2025, which gives us the confidence to say we're going to have positive free cash flow for the first time in our history and actually stockpiling some capital onto the balance sheet and deleveraging the small amount that we have drawn on a revolving credit facility. Beyond that, in the medium term, we have County Line, which is going to be coming into production in the medium term of the next couple of years. Granite Creek, I-80's underground mine there is going to be coming into production. Odyssey, again, that's the underground extension of Canadian Malartic as Agnico Eagle converts from an open pit to underground operation. We have substantially more royalty coverage on the underground there, so it'll be a significant, almost exponential source of growth over the 2 to 5 year horizon. And beyond that, Odyssey is still being drilled out. Agnico is still looking to fill the mill, so there are going to be other sources of feed as they look at new underground infrastructure, perhaps a second shaft to deliver increasing production and increasing royalty coverage for us from the Odyssey mine. South Railroad will come into production later this decade. Ren, which is the underground extension of Goldstrike, will be likely integrated into the mine plan at Goldstrike within the next 2 to 3 years, because Ren represents 7 gram plus a ton material versus the less than 1 gram a ton they're mining from the open pit at Goldstrike. So they're likely to sequence that into the mine plan as quickly as possible, given the grade disparity between what they're mining currently and what Ren will deliver.
David, you have a very unique background in that you were the CEO of a large gold producer in Goldcorp before it was acquired by Newmont, and now you're the CEO of a royalty company. What do you think will do better in this current economic environment, a producer or a royalty company?
Well, it's not an accident that I have not gone back to an operating company. I've been doing that for 35 years, and I'm a big believer in gold price fundamentals. And I think that's been borne out over the last couple of years. I was much more concerned about the ability of the industry from the producer universe to deliver leverage to the gold price, simply because we are not immune from cost inflation that we're experiencing in the general economy. And we've seen that with all-in sustaining costs steadily creeping up with the gold price and really eroding margins rather than delivering leverage to the gold price, but also because of the lack of access to capital for the explorers in our industry over the last dozen years. We haven't seen significant discoveries to replace depleting reserves. And if you look across the industry, reserves in the ground are down 40%. And so the industry has necessarily cannibalized itself. And that, as you know, at best is a zero-sum game. It creates increased share count, but doesn't increase reserves or production leverage in the gold industry. And so I don't see a path to growth for the industry. And not to pick on the bellwether stocks in our space, but if you look at the two biggest producers in the world, Barrick and Newmont, they're at the same production level they were back 30 years ago when I started in the gold industry. And their share prices are lower than they were back 30 years ago, simply because the only thing they've been able to grow in 30 years is their share count, not their production and reserves. They're at suboptimal production levels. And they've had to go on this continual treadmill of taking over other companies in order to sustain unsustainable production and reserve levels. They're just too big to grow. And that's the challenge that the industry faces from a producer standpoint, in addition to cost inflation. So I think the best place to be, quite frankly, is in the royalty universe, where you get that top line exposure and complete upside to the exploration of our operating partners without actually having to contribute to their exploration budgets and worry about cost inflation at the mine site level. We're completely insulated from that. So you're getting leverage to gold, leverage to exploration, unmitigated.
Yeah, you're right about cost inflation, and we saw this with Newmont's recent quarter. Their all-in sustaining costs went from $1,400 up to $1,600 in the past year or so. Inflation has not stopped. And I think the other thing that really stands out to me too is this whole scalability of the royalty model. And in gold royalty, you have 8 full-time employees, but it doesn't matter if you take on another 10, 20, 30 royalties, you do not have to add additional people.
Well, we've gone from 18 royalties at our IPO to over 240 royalties in 3.5 years. I haven't added any headcount to do that. We could go to 2,400 royalties without having to add to the headcount. That's the beauty of the scalable model that we currently enjoy in the royalty space.
And you touched on M&A within the mining sector, and you mentioned Newmont and Barrick, how they have not really grown their production in the last 10, 20 years. But the one thing they are doing is they're acquiring other companies. And we've seen Newmont in the past year, they acquired Newcrest. Agnico has acquired many companies. One of the more recent ones is O3 Mining. That's not a producer, but nonetheless, do you see this trend continuing within the mining sector?
Yeah, look, I think if you're not finding it, you're going to have to buy it. So as I said, that cannibalization is inevitable for these larger producers that are trying to maintain relevance. The holy grail for many of these large scale producers is trying to get the generalist investors to buy into the industry. And they're not going to do that by descaling. They need to create liquidity, scale to attract the generalist players in the space, generalist equity investors. And so they're going to continue to look at acquisition opportunities to replace depleting reserves and production within their own profile. I mean, Newmont's done two very large scale deals in 4 years, one of which I was party to when I merged Goldcorp with Newmont back in 2019, thinking that would set up Newmont for next 10 to 20 years. But 4 years later, they had to do Newcrest basically to get back to where they thought they were going to get with the Goldcorp merger.
Yes, it's interesting times within the mining space, that is for sure. David, as we wrap up, maybe you can just summarize why investors should look at Gold Royalty, because there's many different royalty companies out there, but why should they look at Gold Royalty?
Well, we have peer leading growth in the industry. And when I say peers, I'm talking about from seniors right down to juniors in the royalty space with 60% compounded annual growth in our revenue through the end of the decade from some of the biggest producing gold mines in North America, particularly Canadian Malartic, Côté, and the underground extension of Goldstrike and Ren. So we've got some foundational assets with long lives. And over 80% of our portfolio is in some of the best jurisdictions in the world, in Nevada, Quebec, and Ontario, that have the best mineral prospectivity, the lowest political risk, and the lowest regulatory risk. So you're getting pronounced growth from some of the best assets and some of the best jurisdictions in the world. And on a consensus basis, we're trading at below 0.5 times NAV. We've been penalized for this growth, but I would just hasten to add that this growth is entirely paid for. We never have another capital call. We have no cost exposures. We're completely insulated from inflation. So this growth is providing unmitigated leverage to the gold price. And with our operating partners investing over over $200 million a year in exploration on their underlying projects, we're getting the full benefit of their exploration efforts, which will deliver increasing gold exposure over time.
And in terms of news flow, what can investors expect in the first half of the year?
Look, there's three projects that are achieving full-scale production, and that's Borborema, Côté, and Vars. They're the biggest drivers of our revenue growth over the course of the next year. And beyond that, we have the Odyssey Underground coming on. We have County Line. We have Granite Creek. We have Ren, all of which are providing multiple legs of growth over the next 5 years to deliver that 60% compounded annual growth in our revenue. That means substantial free cash flow growth. We're going to be talking about returns of capital to shareholders as we deliver consistent and growing positive free cash flow from this existing business that's completely bought and paid for.
Well, it sounds like you and your team are going to be very busy in 2025, and I want to thank you very much for providing us with an update.
Thanks, Jimmy.
Did you know that every time you hit the subscribe button, your name goes into a draw to win $1 million? I'm just kidding. But if you do subscribe, it really helps us build our channel. Thank you for subscribing, and thanks for your support. Chris, thank you very much for joining us today. How are things in Toronto?
Great, James. Thanks for having me. And yeah, things are good. Snow, powder, can't complain.
So there is so much happening in Canada right now, and our federal government is in a total state of disarray. We also have a potential trade war coming up with the U.S. We have a new administration in the U.S. that wants lower taxes and higher tariffs and also deregulation and deportation. Some people say these policies will be inflationary. Other people say it will not be. And then you also have the uncertainty with the last Fed meeting that we had in late December, where the Fed came out and they gave us a view that they might cut twice in 2025 versus their previous expectation of cutting 3 times. So on the back of that, we've seen a lot of uncertainty and a lot of volatility in the markets. Why don't we just start right here with the bigger picture? When you look at the U.S. markets, the S&P and the NASDAQ, what are you seeing? What are your views?
Yeah, so I think there's a lot of kind of layers to this onion. There's a lot that's kind of going on in the markets, a lot of mixed signals, which is why I think so many people are nervous. There's a lot of uncertainty. It's why we've seen gold, I think, do well. But uncertainty continues to climb. So when we look at the big picture, Let's kind of look at the big kind of weekly view of the market. So the first thing as investors, we need to understand we're going to be in a bullish or rising tide environment, or we're going to be in a bearish environment, a falling tide. You don't want to own equities. And we are still in a bullish environment. Now, the market has sold off a little bit in the past couple of weeks. Short-term wise, we've exited the market. Long-term investment wise, should still be long this market. So that's kind of where we are. We're in a rising tide environment and having a little bit of a market correction. Now, if we look at the SP 500 here, there's an interesting scenario unfolding here in terms of cycles. I'm big into cycle analysis, and pretty much what we've seen during all of these standout lows, these specific standout lows, is a cluster of multiple different types of cycles coming into play. And it's hard to see, but it's at the bottom of my indicator, these red boxes. These are times where the market resets. And we have to exit the market because we think the markets potentially could continue to sell off. You never know how far a market is going to fall. So if it starts a downtrend, we get out. Now, where we are right now in terms of the market, we're having a short-term downtrend. Right now, the market is putting in this kind of a cluster, a cycle low, and we are in a long-term bullish phase. As I just showed you, James, typically dips can be bought and the markets want to go higher. My analysis shows the SP 500 could rally about 5 to maybe 7%. The NASDAQ could rally maybe about 11% from here. So this to me is like icing on the cake. I think it'll be like a free trade, a bonus trade. I don't think the markets are going much higher than that. I feel like if that happens, it's again, just a once-off opportunity. I do feel like in the grand scheme of things, this market is going to be going a lot lower this year. I think the major market is putting in a top. And the long-term scenario of what is happening right here in terms of money flows in different asset classes is the same we saw over here. Money is starting to flow away from equities. It's starting to break down. And, so I'm very neutral to, neutral on this market. It could go either way at this point. We just need to see which way things are going to flip here over the next week or two, I think.
And I just want to clarify one thing. When you said the market can lift 5 to 6% on the S&P, and I think you said 11% on the NASDAQ, at that point, do you see it topping out and then we see a significant pullback?
Yeah, I think that could be what we see. Very similar to over here. You poke into just a nominal new little high. Everybody gets really bullish one last time, and then the market tanks and falls.
And what sort of pullback would you anticipate percentage-wise?
Yeah, percentage-wise. So if we use a Fibonacci retracement, which is a great tool to gauge how much of a pullback should happen, we can gauge this whole rally here and how much the pullback could go. So roughly, let's just go from these highs over here. I think we could see about potentially a 16 to 20% pullback would be the first really sharp pullback in the markets. From there, it'll have some type of bounce. So that there is quite a bit of downside potential from the market. I mean, this is the most conservative play right there, and current price of the market is right about here. So it's about a 12% from where we are. And that's a really critical pivot point in the chart based on this pivot low and this noise and consolidation through here. And of course, it's also a 38% retrace back. That's typically the first level that stocks pull back to and bounce. So there is quite a bit of downside and not as much upside potential here going forward.
So one of the reasons why we've seen this pullback in the last few weeks is because of the commentary out of the Fed. The economy is a lot stronger than people had anticipated. And so therefore, we're not going to see the same interest rate cuts that we thought we were going to see. But why don't we take a look at the interest rates right now, the 10-year bond or whatever chart you want to look at, just to get an idea of what's happening here.
Yeah, if we take a look at the 10-year note, it's definitely showing signs of strength. I think the best way to show this is kind of the monthly chart. Obviously, we've had a 40-year decline, falling interest rates. Now the tide has turned, and believe it or not, this is a very, very bullish chart pattern showing that interest rates could continue to keep going higher. And a lot of people aren't expecting that, but this is showing huge upside move. And I don't think a lot of people want to be around for this, but we could see like 8+% on the rate, which would be obviously devastating probably for the stock market. For real estate, things could get really ugly. But overall, we are seeing this hold up really well. If this does continue to happen, the bond market, like TLT, the long-term treasury bond ETF, is going to continue to fall and continue to struggle. Now, when we look at this monthly chart, it has been in a bearish pattern for a long time. It's showing signs of increased volatility. It has what looks like could be a signature of 3 surges to a low. So 1, 2, and then potentially one more big drop if interest rates go up. And 3 surges usually triggers a massive reversal, and it can change the tide in a whole new direction. So it's going to be very interesting to see how this unfolds. I think bonds are going to be a good play at some point, but right now you're really just, it's a high risk play, and there could be another very big down leg. If rates go up, this is going to go down dramatically. So,
Chris, do you mind going back to the interest rate chart that you had up there?
Yep.
Because what I find very interesting here is that I recently had a discussion with an economist, Juliet de Klerk, and she thinks that she sees the same sort of thing that you do, except her analysis is based on an economic analysis. And she thinks the Fed has lost control of the long end of the curve. And we're going to see the long end of the curve go significantly higher. The Fed and the Treasury are not going to be able to do anything. The Fed is got the short end of the curve under control, but they can't do anything about the long end. And so therefore, what's going to happen is the Treasury or the federal government is going to have to finance trillions of dollars of debt at a much higher interest rate, and this is going to put a lot of stress on the U.S. economy. So it's going to be interesting to see how this plays out in the coming months.
For sure.
So that is what you think is going to happen with interest rates. Why don't we take a look at the U.S. dollar, because all of these components are interrelated. So I want to see the U.S. dollar has been very strong. It was up, it's trading at or near all-time highs against the Canadian dollar. I think the Canadian dollar lost about 10% against the USD last year. It's at a 22-year low. What do you see here?
Yeah, I think the US dollar's got another big leg up. I think typically when we see chaos in the markets, like the 2000 financial crash, we had the 2008 financial crash, financial reset. I think we're going to see, a big leg up here on the next move. We've got rising lows, like higher lows, higher highs. The dollar's channeling up, and I believe we're going to continue to see this move up. And this is going to strengthen, obviously, the dollar, and it's going to wreak havoc for a lot of other currencies. When we look at all these other currencies here, the dollar has been moving up very strong compared to all the other currencies. And so this is going to cause a big problem, I think, even with U.S. companies, multinational companies who deal across, around the globe. The U.S. dollar is going to become so expensive that they're going to have to cut their pricing, cut their all this stuff. It's going to hurt sales, and it's going to really cause a lot of problems with earnings. And of course, that bleeds over to layoffs and cost cutting and all kinds of stuff, which creates this whole snowball effect or adds to the whole kind of, I think we're going to see a global recession take place. So bullish on the dollar. I think this will put pressure on commodities. It'll put pressure on a lot of stuff temporarily. But I think the dollar is a low volatility, bullish move. It's a way to take advantage of chaos without having to be in something really volatile.
And you and I both reside in Toronto, so why don't we take a look at the Canadian dollar versus the USD?
Sure, yeah.
This exchange rate is killing me now. I can't even afford to do a trip to New York.
I know, it's
Paying a
wild.
40% premium for restaurants and hotels and
Yep. So looking at the US and Canadian dollar, right now, $1 US is $1.43 for us Canadians. Very expensive. Based on this chart and based what I think is unfolding, I think we're going to see oil break down, which means that the Canadian loonie will fall in value. I think we're going to see the US dollar go up, which means it's going to create this huge spread. Based on this chart pattern, I think we could actually see about a $1.74 exchange, which is enough to make most people cringe. Canadians, you're not going to want to go to the States to go on holidays anymore. So there is potential for some huge moves across the board. And I mean, this is what happened in the tech bubble, the financial crisis, oil going to zero not that long ago. Anything can happen. And I think this year is going to be a year of just stuff will be like, wow, I never knew that could happen. It'll just be another one of those years. And the key is of being able to identify and navigate these so that you can come out unscathed or hopefully with a lot more money because there's ways to take advantage of all of these plays. So I would expect the US dollar to go up. And if you own equities or own real estate in the United States, it's a real trade-off. There's a great exchange rate. It might go a little bit higher, but liquidating and going to cash, holding US dollars is a really good play because if you think about it, if real estate is going to crash and you own US real estate, I'm looking from a Canadian perspective, sell the US property, you go to cash, but keep it in US dollars. The US dollar is about to rally like 20%. And then once all chaos hits and the dollar spikes up, cash out of the US dollars, move to Canadian. And I think the Canadian dollar will rise from the ashes. I think it's going to come down to a resource kind of move. And we're going to see resource heavy currencies like the Canadian dollar become a powerhouse and come back from the dead and allow you to grow your wealth really well. So there's some really good plays unfolding here.
And Chris, one of the reasons why we're seeing a lot of weakness in the Canadian dollar is because of what's happening here within the country. And the Canadian economy is very weak, in spite of the fact that we're neighbors with the US, which is the strongest economy in the world. It continues to grow at 2.5 to 3%, but our economy is very weak. And maybe you can just talk about that and where you see, what are your views of the Canadian economy and where you see it going in the coming months?
Yeah, I mean, I don't have any Canadian data, but I do feel like Canada and the United States follow pretty similar patterns in terms of what everything is doing. I mean, job openings have been falling. When we look at unemployment rate, it has been going up, even though there was a little pullback. It really means nothing. It's just one piece of data. We actually saw a little bit of a hiccup for a few quarters just before the 2008 financial crisis, where unemployment took off. So I think we're in the same boat. I think Canada is a little bit weaker, as you said there, James, but the overall picture, generally the United States, North America, we all kind of move as one. One might lead the other a little bit, but I think we are on the cusp of seeing things slow down. We're going to see, I think, real estate market get hit very hard in terms of real estate pricing. If we take a look at real estate pricing, I think single family homes are about to fall off a cliff. And that is going to, a lot of investors are going to tighten their wallets to be like, wow, my house property just fell like $300,000 in value in the last, 4 months. And they're going to see the stock market start to go down. And that's going to close people's wallets. They stop buying. Businesses, where's that chart? Pull it up here. Businesses start trimming back labor because sales slow down because everybody tightens their wallets and unemployment spikes. So what happens in the States is going to happen in Canada or vice versa. We're all kind of one. I generally follow US data just because there's more of it. Don't know if it's more accurate, but there's more of it.
And in terms of real estate, everywhere I go, I'm seeing for sale signs in Southern Ontario. What are your thoughts on real estate?
Yeah. I mean, this is a really good chart. This is the same in Canada. This is the pending home sales. So during COVID, when no one could really buy a house, pending home sales fell to a record low. And here we are with just natural markets doing their things. No one is buying homes. And that's why we have this huge surplus of homes right now. We've got, hundreds in my town, there's hundreds, almost 700 homes for sale that aren't selling. And that really is based off this. There's a lot of people putting homes up for sale, but they're not selling because no one wants to drop their price and be like, oh, I don't want to drop it and go below market value. Meanwhile, nobody's selling because market value is below all of their current pricing. And nobody wants to be the first one to be like, oh, and get called like, oh, you gave your house away, right? But once that starts, we're going to see this. And Canada, I think, is definitely going to see a more severe pullback, I think, simply because we got mortgages coming up for renewal. We've got 3, 5, 7-year mortgages. The 5 years are going to be coming up here, and people cannot afford the mortgage rates. In fact, again, this is US data, but look at the mortgage rates just since September, really even November, up until now. Mortgage rates continue to climb. People cannot afford in Canada to refinance at these rates, which means homes are going for sale in the spring, and there might be a little bit of an uptick with action, but overall, home prices are going to get hit real hard in Canada simply because we're forced to renew our mortgage, and we have to do it at a higher rate. United States, you like lock in a mortgage for like 30 years. It's like, it's unbelievable. It's amazing. But in Canada, we just get slaughtered in terms of our shorter term mortgages.
One more point I should make this year in 2025, there's over 1 million mortgages coming up for renewal. So there's going to be a lot of pain. And that's why the Bank of Canada has been so aggressive here in 2024 in cutting rates because they're trying to get the rates down. They know there's this pending
Yeah.
problem on the horizon and they're trying to get in front of it. But I think it's too little too late. And so I got to ask you about gold. We talked about the US dollar, we talked about interest rates. And during these periods of uncertainty, myself, I always like to have an allocation toward gold. It did very well in 2024. I think it was the best year in 14 years.
Mm.
Where do you see gold going?
Yeah, so gold is still bullish. Gold is still in a strong uptrend. Now it has hit 100% measured move based on two major cycles. So the last super cycle, from the low to the high and down to this low, if we draw that out, Fibonacci shows, whoops, that we hit this level. And this was something I had talked about back in 2019 when we broke into this new bull market phase. I was able to say, hey, listen, the next major goal, upside target is going to be this 618 target, and it should pause, and then we should go up to that 100%. And so we've hit that on this monthly chart. And what's really interesting too, James, is if we look at the shorter one, this fresh news cycle to the rally up and this pullback, and we carry it forward, gold has also hit that 100% measured move. So it doesn't matter what half of this cycle you look at or which pattern, we have hit those levels. So I think there is a little bit of upside left in gold. We might see one more push, potentially to 3,050. So there is percentage-wise potentially one blow-off phase. And that's typically kind of what happens near the end of a move. You have a blow-off phase, and we could see a big spike up, and then it can get hit. And then I think we'll see it correct and pull back with the financial systems and all of that stuff, forced liquidation. And then there'll be an opportunity to get in for the next multi-year rally. It'll kind of be like buying back at 2008, 2009 lows and having that 4 or 5 year rally to the upside. So I'm neutral to bullish on gold. It's hit both of its targets. We actually closed our gold position, and now we're moving elsewhere. We're going to let gold do its thing here and then reload during the next financial reset and get into gold miners and silver and that stuff.
I'm surprised how strong gold has been, even in the face of a strong US dollar. Typically, they move inversely, but the two have been moving together in the last year.
Yeah, when you look at gold, it's been up and to the right. And if I just flip to the dollar chart, it's pretty much been, well, not quite the same, more so recently in the last 6 months or so, up and to the right, both of them. So this is a warning sign. I mean, I think the whole world is liquidating. They're counting on the US coming out ahead of the game. And then of course, people moving to physical gold is get me out of the financial system. Our banks going bankrupt, or, real estate going to pop, stocks going to, burst, that bubble and everything unwind. So people are trying to just get to cash, get to physical gold. It's why Bitcoin, I think, has done well. People are just trying to get away from the financial system because I think we're going to have a financial crash. And that's just how money flows. Money flows to where they think it's safest at any given time.
Yeah, and there's nothing better than gold in the hand.
Yeah, you're right.
So it sounds like 2025 is going to be a volatile year. I mean, the big issue is there's a lot of unknowns in terms of what sort of policies are going to be implemented in the next 100 days and what those policies are going to do to the economy and I guess also other countries like Canada, for example, and if there's going to be trade wars.
Yeah.
Trump has also said he wants to take over Greenland and Panama, so it sounds like it's going to be a very interesting year. Well, I guess the other thing I should mention too, you mentioned the US dollar, you see it continuing going higher, but Trump wants a lower US dollar because he wants to bring everything back to the US and he wants to make the US more competitive. But it's going to be tough to do that if the US dollar continues to move higher.
Yeah, easier said than done for sure. And I mean, this just goes like I see comments all the time. People are like, well, there's no way Trump's going to let interest rates go up. He's got real estate and he's not going to let the dollar go up. But the reality is one person can't truly control the overall market. What's going to happen is going to happen. He might try to do some stuff, but the reality is the market really is so big. And when the momentum starts in a direction, you can't stop it. He can't just knock rates down and knock the dollar down just for his portfolio. It doesn't work that simple, really.
Well, that was a great discussion, Chris, and I want to thank you very much for spending time with us today. If somebody would like to learn more about you and your various services, where can they go?
Yeah, they can go to my website, which is thetechnicaltraders.com, or go to my YouTube channel and subscribe there at The Technical Traders. And um, I have a little comparison chart here of the strategy that I deploy. So what I offer at my service, which you can click at your link below here in your description, James, is this strategy called the ACS, which is the adaptive compounding strategy. It's this top line right here. We're actually keeping up with the NASDAQ since the 2008 market top. We have similar returns as the NASDAQ, which most people would kill to match that type of performance. And our max drawdowns, because we use ETFs and we rotate from one asset to the next, as one starts to stall out, we move into a different asset. You can see the difference in risk. The NASDAQ 50% downside versus ours less than 6%. So this is what I offer at my newsletter, which again, you can follow at your link that you've got below there for subscribers.
Yes, I will have a link in the show notes. Well, Chris, once again, thank you.
Yeah, thanks, James. It's always a pleasure. Take care.
Sean, thank you very much for joining us today. You are the chair and the CEO of Osisko Development. You're also the founder of the Osisko Group of Companies, and you and your team have done a great job in creating shareholder value with many of your companies being acquired over the years. Why don't you take us through a couple of the larger acquisitions?
Absolutely. Yeah. Thanks very much, Jimmy. And thanks to all your viewers for keeping the faith. And hopefully we can tell a good resource story today. And we're very optimistic about where we're headed with this. And the Osisko platform has been around. We founded it essentially in 2003 with the acquisition of the Canadian Malartic project for $88,888 from a bankruptcy sale, which founded Canada's largest gold mine, the Canadian Malartic mine, which we went on to build and permit. And we built the permit in 2009, built it and finished it in 2011. We got put into a hostile by Goldcorp in 2014. We sold that company to a joint venture between Yamana and Agnico for $4.1 billion. With that, we created a spinco called Osisko Gold Royalties. It's still around right now, called OR on the New York Stock Exchange. I was the founding CEO and chairman of that. We took that company from an IPO of $500 million with one producing royalty to a $5 billion royalty company, now the fourth largest royalty company in the world. And that company is very active right now. And I think, probably it's top, I think it's number 4 royalty company in the precious metal space worldwide. So Franco, Wheaton, and Royal Gold, and then us. Then we spun out several, what we call our accelerator companies, which we incubated companies and took royalties in the early days. And we created about 19 companies from that platform. The most recent one was Osisko Mining 2. We sold that to Goldfields in November for $2.1 billion. We also created Osisko 3, which is a project that's located near Canadian Malartic. And that's being sold to Agnico right now for about $400 million. And I'm currently focused on ODV, Osisko Development Corporation, ODV on the NYSE. And we've got 2 main projects, the Caribou Gold Project in central BC near Prince George, BC. We just received a 5,000 ton a day mining permit, an environmental permit for that project. So that's Canada's next big gold mine build. And we also have a project in Utah in that one that we're drilling for a copper porphyry that we hope is a Bingham lookalike, about 40 miles south of Bingham, in a place called Tintic, with Robert Friedland on our southwest border with Ivanhoe Electric. Freeport to the south, so pretty excited about that. The drills are turning again, which always makes me happy. And then, and we have a couple other projects in there. Within the platform, we also have Osisko Metals, which has the Gas Bay Copper project that was previously a Noranda mine. It's about 1.5 billion tons of 0.36 historic mine site. They also have the Pine Point project in the Northwest Territories, silver lead zinc mine that's advancing. Within the lithium space, we have a couple other companies within the group, BRW, and things that have quite a bit of exposure to the lithium market, and about 6 or 7 different discoveries in that space. We also have Falco Resources, which has the Horn 5 mine in the project. So we've created quite a few projects over the years. We're at about 140 million ounces in total discoveries. We've raised collectively about $3.6 billion in equities. And our market cap of all of our companies combined is now past $12 billion. So we're a pretty active group. We've had the ability to stay in business for close to 20 years now. We really started in 2003, so it's we've stood the test of time with our business models, and our specialty is what I would call brownfield exploration, where we go into brownfield camps, consolidate historic data, try to put a new spin on it. We led the charge in terms of open pit, low grade bulk tonnage mining in Canada, with Canadian Malartic being the big mine that's now part of Agnico. That mine produces between 650 and 750,000 ounces a year. 9th largest mine in the world. So that we're focused on these world-class assets and these historic mining camps. That's really our business plan. The most recent one is the Caribou Gold Project in BC, which we can get into as well. And that's sort of what gets us to where we are today, Jimmy.
That's a great overview. And as you mentioned, we're here today to talk about Osisko development, and the primary project is the Caribou Gold Project. Why don't we just start with a very high level of this project, and then we'll take it from there.
So currently the resource is 2 million ounces in drilled reserves and another 3.3 million ounces in measured and indicated and inferred, at a grade of about 3.78 grams in the reserves and about 3.6 grams in the inferred category. This is a classic Osisko story. This was a mining camp since 1858. When the first discovery was made, at one point in time, it was the largest city north of San Francisco. And it's the reason that British Columbia was picked up in the consolidation of the Confederation of Canada, is because they thought there was too many Americans coming out of the California 49er gold rush, moving to BC. If they didn't include BC, that there was going to be a problem here. So that's the lineage of it. It's produced about 4 million ounces historically. We went back in with a new plan in 2016. We couldn't understand the geological model that had been historically on it, which was the same case as what happened to us in Canadian Malartic. When we got there, we realized that nobody had actually tried to understand the genetics of these deposits and why we're there, and nobody was really focused on the effects of the low-grade bulk tonnage model. So we got involved at that time and consolidated a project, permit there of about 2,000 square kilometers, or about 500,000 acres. So this is a mining camp that we're working on. The 2023 feasibility study was the first piece, down to a depth of about 1,000 feet or 350 meters. And we drilled 800,000 meters, and we generated the overall resource of 2 million reserves and 3.3 in resource. And we averaged about 15 to 22,000 ounces per vertical meter over a strike length of about 4.6 kilometers. We drilled the deposit down to 1,000 meters, but not in enough detail to hang a resource on it. But we know that the genetics of this thing is an orogenic system. It goes well past 1,000 meters. So you guys can do the math at 50, so every 100 meters we've gone down in this thing, we've generated between 1.5 and 2.2 million ounces in total resource. So it's a pretty interesting piece of geology. It's somewhat unique. It's in the Younger Age rock, so it's outside of the traditional Archean greenstone belts. It's in the Jurassic Age rock, so it took us a bit of time to unwind the geological story behind this. And when we looked at what the old timers were mining these high grade replacement zones that would average between 15 and 20 grams. But they're a lot like chocolate chips in the cookie. They're very hard to predict where they will be, and very difficult to drill from surface. And historically, where the success came was the old timers were able to drift around and look for these things from the underground. We went in with a much more different plan. We looked at the actual structures, and there's an accordion style mineralization along this fracture on a big anticline. So the crust is folded up and this thing is cracked open. We've been able to develop that model to the point where we were able to predict it. The continuity of the grade was there. And within these fractures that you get, and they repeat about every 8 to 9 meters along the strike length of this thing. and there's a harmonic of about every 1.5 kilometers where you see this anticline, then you have the synclinal structure, the anticlinal structure. So we drilled it out over 4.6 kilometers. So we're averaging about 1.2 million ounces per linear kilometer of strike length, and then about 1.5 million ounces per vertical meter in that strike length. So it's a big system. We also, when we looked at this, we said, well, we're not going to be able to do what the old timers did, which is to do narrow vein mining on this. This has to be a highly mechanized operation, and I'm a bulk tonnage guy. As I like to say, I like my deposits like me, kind of big and dumb. Where we can focus on the mechanization, efficiencies, and we can run a fairly green mine in terms of being able to use a lot of electrical energy in the mine to actually do the mining and development work. So we've worked on that plan. We published the feasibility study in 2023. We're doing an updated one for this year. The strategy that we took on back in 2019 was we needed to get the permit. So we applied for the EA certificate and the mining permit in 2019. We received the EA certificate in October 2023. And for everybody in this space that knows the game, there are two types of projects in this sector right now. The projects with permits and all the rest. So this one transitioned to the mine with permits in November of 2024. So we received our EA certificate fall 2023, and then a bit later, we received the final mining permit and the environmental permit for this mine just after the NDP election win in BC. So a call out to the NDP government for being active and getting that permit to us. It was their first active business as a new government in the fall. They formed the government on Monday, appointed the ministers on Tuesday, and we got our permit on Wednesday. So that's pretty good commitment from the current BC government, and I think they're moving up the list of the Fraser Institute in terms of investability for BC. There's an awful lot of potential in BC, so we're pretty happy to be there, and we think this is, it's always been a great jurisdiction for mining, but I think the bureaucracy and the permitting is being tamed. They've gone to a single wicket approach, and this is the next big project to be built in Canada, most recently permitted. So it's about a 750 million Canadian dollar mine build to go to 5,000 tons a day, which will produce somewhere between 180 and 220,000 ounces a year over a period of 10 years. The exploration upside here is at depth. We've got the deposit. We know it goes down to at least 1,000 meters. We've only done detailed drilling to 350 because of these vertical structures. It's hard to drill them from surface. It's much easier to be drilling from underground as we progress down at a steeper angle to hit these things at a more oblique, more perpendicular angle. So this is a mining camp in my view, and the reason that I'm putting my time in right now, I do have a nice cottage that I could be hanging out at, but my passion is wealth creation at the drill bit and exploration, and we've been very successful in terms of finding these projects, and internally we call this one the Canadian Malartic, the underground version. It's a project that a lot of people have opinions about from the past, but we've done the new science to it, and I always say to everybody, if you haven't looked at the database since we drilled it, we put 800,000 meters of brand new drilling into this thing, looking for the bulk sample aspect of the project as opposed to these historic high-grade chocolate chips in the cookie. And we've been able to unwind the story in a way that it hasn't been unwound before, much like we went to Canadian Malartic. Everybody talked it down. We never raised any money for that project in Montreal or Toronto back in the day because everybody said 1 gram in Quebec wouldn't work. It's now Canada's largest gold mine, 9th largest gold mine in the world. And Agnico just announced another 16 million ounces at it. So it's a total, that deposit is now 30 million ounces. So that's the business that we are in, is to think outside the box, get going, do real science, and then get in and drill prove it with a truth machine. And as you know, Jimmy, we have the internal policy at Osisko is called SUDS, which stands for Shut Up and Drill Stupid. So, that's where we live. That's where we've made shareholders money.
Sean, you mentioned that you did a feasibility study in 2023, but you're working on another one now. Why?
We're doing an optimized, updated feasibility. A few reasons. We've made some strides in terms of our metallurgical recoveries. In terms of additional work, the process we're using is the ore sorter, which is a fairly passive technology, if you will. I mean, you're just taking an X-ray of it, and it goes off the end of a conveyor, and there's a little pneumatic air valve that, if it's depending on how you want to select it, it's a piece of waste rock. It gives a little shot of air, and it pushes it in over another divider. So we get about a 50% upgrading grade. So we're coming in at sort of 3 to 4 grams. We'll be coming out at sort of 6 to 8 grams at the other end, and that's but it costs us about $1.50 a ton to do that process. And it's just the X-ray doesn't touch the actual material, and then it goes off the bin. And we use a sizing laser as well, an optical sizer, not for color scanning, but just to size the particles. And the advance in technology there has been the algorithm to process that information in real time, make decisions before the material gets to the end of the belt, and do a selection there. So that material, we're doing a big test. We're sending that to Saskatchewan, to the Saskatchewan Research Institute, to do the optimized ore sorter development with a company called Tomory. There's 2 big ore sorter companies in the world, Steinhardt and Tomory. We've gone with Tomory for this one. And then, in terms of our other update, is we've been able to install a gravity circuit and increase the efficiency of our flotation circuit. So we're looking to be able to produce a gravity con. Before we didn't have one. Now we're looking at sort of 25% of our material being treated just with gravity, which is a very low cost and very effective way to do things. Mostly sort of a Falcon or Nelson concentrator level. And the other thing is a flotation concentrate, which allows us to produce. Originally, we thought we were going to produce about a 28 gram a ton concentrate, and 5,000 tons, we would sort of have around 500 to 700 tons a day of concentrate. By increasing the flotation, we're able to reduce the number of tons of concentrate we're producing a day, and also increase the grade of that concentrate. So we're targeting to be somewhere between the 100 and 200 gram a ton concentrate, which allows us to take all those sulfides out with the flotation circuit, which means that we have a super clean tail, and that'll go back underground as backfill. So we've been able to optimize the mining sequence and sync it up with the new flotation test work that we've done, as well as the gravity work. That combined with the overall met package, including the optimization with the evolution of the algorithms and the CPU units, and in the ore sorter, it required an update to the feasibility to take advantage of these pieces of progress. So I think it's a pretty exciting time for us. It's going to be a very clean mine, very green mine, and we're looking to be electrified as many ways as we can. So this is a highly mechanized mine, so we'll be able to use battery operated electric trucks for haulage. A lot of our equipment, the road header, is fully electric, hydraulic. And it mines about 2.5 meters stationarily and just grinds away, and push a button, it does 2.5 meters of mining when things are going well.
And in terms of the timeline to production, okay, so you got your permits, you're waiting on the bulk sample results, which should be out in Q1 or Q2. What's the best case scenario in terms of production?
Right now it's 2027. We'll have some, evolution where we have all the permits that we need to go mining right now. So subject to project financing, which is what we're working on now, that'll be one of the next big milestones. So, we've got the bulk sample is underway, but we've got 1,200 meters of underground development in place. We've got access to about 20 vein corridors from the underground now, which is great to actually be in the ore body, and we'll be able to bring a lot of people there in the next sort of 2 to 3 months. In terms of showing people this. There was a lot of skepticism about this project in the past, because nobody could get the results that we got, because they were drilling all over the place, and there was no continuity. We didn't figure it out. It took us 3 years of science to figure out what we were actually looking for, and to step away from looking for these sort of chocolate chip style deposits that are all throughout it, and go and focus on the bulk tonnage aspect of it. So project financing will be a big catalyst to how fast we can develop that. And also we're drilling from the underground now, which allows the angle of attack to be much more efficient. We can hit 5-10 of these things per drill hole now, So we increased the number of intercepts with the actual vein corridors, which allows us to convert ounces very quickly. So we've got 2 million ounces of reserve category right now. We're looking to do more detailed drilling on the other 3.3 million ounces. And we're assuming some sort of between a 60 and 70% conversion rate on those other 3 million ounces. So with that infill work, the goal would be to get this thing to 3.5, 4 million ounces of mineral reserve within the next 12 to 18 months. And that would set the stage for, saying hello to 5,000 tons a day and hopefully going past it.
Well, that's a great overview.
The caveat on that is we're going to have to increase our permitting as we do that. But, our footprint's in place already. So it's really just about increasing the permitting for the underground. So that's a bit of an overview of it. We think this is going to be an important asset. In terms of where this fits in the food chain of things that a big company would like to own, it's a lot like Canadian Malartic. Once we built it, it became very popular until we, if you looked at it in 09, before we financed the 09 financing, we probably had a market cap of $400 or $500 million. And we ended up selling it for $4.1 billion in 2014. So, our goal is to get through the so-called Lassonde curve. And at the other end, I think we're very much near the end of it now. We've achieved permitting. We've got, the reserve base is good. The amount of drilling that we've done there, we also, when it comes to, if we're going to mine, you say drill twice, mine once. And if you get it backwards, it's not good. As we've seen, the biggest problem with underground mining is lack of drilling, lack of resource definition, a lack of mine planning. We're pretty good at that part. And, we're relatively conservative compared to most, I think, when it comes to reserve and mine plan. We built Canadian Malartic. We put 1.8 million meters of drilling into that. And to this day, we're almost at the end of the open pit now. It reconciled at plus 3% off of our original drill resource after all these years of mining. So, we poured gold in 2011, and it's 2025 now, still running a positive reconciliation from our original drill work.
You sold that for $4.2 billion?
$4.1 billion.
What do you think it would be worth today?
Well, right now it's 16 million ounces with a 25,000 ton a day head frame sitting on top of it and a 55,000 ton a day mill. And they just got another discovery. When we sold it, there was 13.8 million ounces of indicated resource in total. And we had the Odyssey discovery, which turned out to be 16 million ounces. So, I would say that conservatively, and it's producing around 650, 700,000 ounces a year. Conservatively, that's about a $15 to $20 billion market cap right now.
Do you think you have another Malartic Caribou?
We certainly do. Yeah, once we crack the code and prove to everybody that we're not as crazy as everybody likes to think we are sometimes. Sometimes there's two types of crazy wrong and crazy right. We've been crazy right more than once. If you look at the stuff that we've done, most of the things that we've touched on have been mines. And if you look at the original Osisko group, a lot of the things that we did in our past turned out to be mines. So we've been to the playoffs. We know what it takes to win the Stanley Cup. And you got to skate every shift, and you can never take anything for granted. But we're pretty happy with where we are in this one. And look forward to getting a lot of sort of the smarter analysts and more technical people to site and show them the underground now that we're actually in the ore body, and we can showcase what we were seeing from the drilling. The bulk samples are going to be indicative of that area, and we'll get a good feel for it. We've got a good feel for the mining costs now, ground conditions, geotech. We've been sort of managing risk one piece at a time. I'm a Hillbridge School of Mines mining guy, so I think in terms of ore and waste and dollars per ton. That's the way we live our lives. And this story has gotten better, not worse. And the telltale for me always, and when I start drilling off deposits, is okay, we drilled this thing on a 100-meter grid, then we reduced to a 50-meter grid. Did the grade go up or down? And then we tighten up to 25-meter grid. Did it go up or down again? In this case, every time we've drilled tighter, the grade has gone up. So that makes me feel good. When we originally drilled Canadian Malartic, we had a resource grade of about 0.8. The tighter drilling, we got to 1.03 grams, so it was almost an increase of 20% of grade with tighter drilling. We've seen similar results here, so those are primary indicatives for a guy like me who spends his day geeking out over mine reserve plans, and that's kind of the way we think about it. And at the end of the day, it's dollars per ton. Gold has performed very well. We're now at 26.70 an ounce, I think. So which is roughly $100 Canadian a gram. So this thing's between 3.5 and 4 grams after capping. So this was pretty good rock. It's $350 to $400 rock. It's in that zone, and most underground mines right now are mining. It's long hole are mining between $80 and $100 a ton. So this is pretty good numbers on this thing, and it's why we saw the AISC around $1,000 an ounce. So the margin's gone up basically about $800 an ounce since we started working on this feasibility study. That's if you take the $1,000 an ounce as a baseline. So it's a great time for a project like this. I think Canada's facing renewed energy and hopefully some simplifications in terms of bureaucracy and a renewed focus on resources between what's happened in the U.S. and what's happening in Canada. That we should see revived enthusiasm for investment in this, and I think that the shareholders should benefit from not just the success of the project, but also the increased focus in the space. And I'm always aiming to be, things that can be in the world-class zone, which we define as 500,000 ounces a year. I think we can get this one to that stage if we continue to invest in it. So that was my assumptions going in, and that's why we've stayed so focused on this since 2016. And as I left the OR royalty business after 10 years of building that company from $500 million to $5 billion, to go and do this as there's more. My passion is more in the exploration development side than in the financial engineering side, which we've proven we can do. But this is my preferred sport.
I like that analogy you used about real estate management, but that was a great detailed overview of what's happening at Osisko Development. And Sean, as we wrap up, maybe you can just tell our viewers what they can expect in terms of news flow in the coming months.
Sure. So we're ODV on the New York Stock Exchange and on the TSXV as well. The main exchange has been the US one. The bulk sample results will be coming out. The updated feasibility is probably the next item to come forward. We're hoping to have that completed here in Q1. We'll probably just publish the numbers first, and then the final report will probably take until Q2 to actually publish. We're working on project finance opportunities now that we're permitted. So stay tuned on that front. But we got a whole lot more friends with a permit in our hand than we did before. So we are also very focused on that. And for anybody that knows me, Jimmy, it's I'm always about build it, they will come. So our goal is to keep pushing up the value curve as far as we can for shareholders. But this project is also, it's top 10, I think, listed by several analysts right now in terms of acquisition targets. So we're dancing that dance, the seven veils in terms of where the project fits in the space. But having a permit, being over 200,000 ounce year producer with legs to go to 500,000 is a pretty rare asset, especially in a jurisdiction like Canada at this point in time. And I think this ends up being a world-class asset with the right work and the right amount of capital, and we're trying to bring to bear that capital to get that work done as quickly as we can. So we'll continue to that. We'll also do some more drilling in the underground to sort of firm up some of the zones that we think can be easily documented. And then if we hit a porphyry copper gold system that looks like Bingham in Utah, Jimmy, I'll call you from the Four Seasons, because we'll be entertaining partnership offers if we were to do that. So we've still got that big lottery ticket out there. And my favorite thing to do in the morning is coffee and drill results. So we're enjoying life right now in terms of being able to do what we like to do, which is drill for undiscovered wealth. That is a brownfield camp. That's downtown. It's got lineage. It's got genetics. It's the biggest mineral endowment second largest mineral endowment outside of Bingham in all of Utah. That area, not just the one that we're in, but also the one that Freeport and Ivanhoe Electric have. So we're a pretty good company in that pursuit. So it's Osisko, Ivanhoe Electric, and Freeport going at it. And lots of drill bits flying around, lots of diesel getting spent in terms of trying to get these geological mysteries figured out. So I think that could be a big one. And then, who knows what happens in Mexico right now. Hopefully, that moratorium on open pit mining gets resolved here in the next 6 to 12 months.
Well, that was a great wrap up, and I'll be waiting for that call, Sean. And once again, I want to thank you for spending time with us today.
Jimmy, thank you very much, and all the best of luck to your viewers and with their investments. And feel free to give us a call. We're on our website, osiskodevelopment.com. Happy to take questions, and our website's pretty fulsome, and there's a good video tour of the mine site out there as well. And for history buffs, the Caribou Gold Project also has a historic site that has live actors in the summertime. So it's a great destination if you want to take your kids and your family out and show them what historic mines. It's the old Barkerville mine site, town about 11 kilometers away from us. And we'll be happy to host anybody that shows up at the door and wants to get a little tour.
Once again, Sean, thank you. Sheldon, thank you very much for joining us today. How are things in Toronto?
They're fantastic. Thanks, Jimmy. Really nice to be here.
So you are the new CEO of Triple Flag Precious Metals. And for those who might not be familiar with you, tell us a little bit about your background.
Yeah, thanks, Jimmy. I was actually one of the 3 founding members of Triple Flag. I joined Sean back in 2016. We didn't have an office. We didn't have a portfolio. We really just were a clean sheet of paper. And what we really wanted to do was we wanted to assemble a portfolio of streams and royalties that really looked a lot like what the leading streaming royalty companies at the time had, which was, Franco-Nevada and Wheaton Precious really were our template. So, I started with Sean then, and we built out the portfolio asset by asset. I was there for Cerro Lindo, our first investment in 2016. And initially I was the general counsel. I had a legal role. And then I moved into the chief financial officer seat in 2019. In 2021, I was the CFO when we IPO'd on the Toronto Stock Exchange. So that was really a real highlight of my career and my time at Triple Flag as well. The next year, we listed on the New York Stock Exchange, and we've just been growing the company ever since. So while I'm new to the role, I'm certainly not new to Triple Flag.
That's good to hear. So you know the company intimately, and we're going to discuss some of your assets now. And Triple Flag has 235 assets, 30 of which are producing. And the largest asset is North Parks, represents 25% of your net asset value. It's a large copper gold mine located in Australia. Why don't you tell us about this asset and give us a brief update on what's happening there?
I look at the streaming and royalty sector. The reason we were interested in it has very good risk-reward characteristics and risk and return characteristics. You get that top-line exposure where you get full exposure to the increase in the gold price, but on the downside, you're just in a much safer position than the equities, which often get hit by dilution, capex expansion, opex expansion. And when you think of like the ideal sort of streaming and royalty asset, I would say it really looks a lot like North Parks. North Parks is, first of all, located in Australia. So if you're going to have 25% of your NAV in any one asset, Australia, I think, is the best place in the world to have that. It's a copper gold asset, so it's primarily a copper mine. And we actually stream the gold and silver out of that. So it's a byproduct. So it means we're not competing with the operator for their primary product. And we were able to offer them good terms, but we really can benefit from the gold and silver production there. The other attribute that's really important about it is it's been in operation for over 30 years. Initially, it was a Rio Tinto asset. Then it was CMOC that ran it. And just over a year ago, was acquired by a group called Evolution Mining, a very successful mining company based in Australia. So, North Parks is right in its backyard. And they're just motivated to explore the property. And when I look at that property, I see tremendous exploration potential. And that's what's really drives some of the outsized returns we see in the streaming and royalty sector. It's when you underwrite a certain mine life and a certain amount of gold and silver going to be delivered to you over the course of the contract. And the company expands and extends that mine life. The streaming and royalty company really, really benefits. The entire footprint of that mine is only 26 square kilometers, but under our contract, we benefit from over 1,000 square kilometers. Evolution is very motivated to explore this property, and I'm really excited about what it has to bring in the future.
So one question about the mine life, you said it was 30 years, is that correct?
Yes.
So one of the things I really enjoy about copper mines is that they can have very long mine lives, unlike a gold, which might be 8, 10, 12 years. But a copper mine can be 25, 50, 75 years. And when you speak to the guys on the ground there, what's the best case scenario? How long can this thing go?
Yeah, it's really interesting. So the mine's been in operation for 30 years. We have about 30 years of mine life right now that we can point to. But when you talk to people on the ground there, they actually say this could be a 100-year mine. It's just underexplored. There's lots of resource there that hasn't been brought into the mine plan yet because the mining company isn't motivated to spend the money to bring those years beyond 30 years into the mine plan because it's just so far off into the future. But we know the mineralization is there. It's quite exciting, and I really am glad you picked up on the point of the advantage of having a gold stream on a copper mine. It's commonly said that the best gold mine is actually the gold coming out of a copper mine.
And the current mine plan at North Parks, it's focused on 5 deposits. Maybe you can just speak to these deposits and which ones will be driving future growth.
Yeah, it's what's really nice about North Parks is they have multiple ore sources, and you correctly flagged that there's a number of different deposits. And so those primarily it's an underground block cave system. There's also some very nice high gold grade pits on the surface. Now, remembering that this is a copper mine primarily, so the operator's going where the copper is, and the gold just comes along for the ride, so to speak, and we get the benefit of that. And so from time to time, they will go into areas that have much higher gold grades, and we actually really, really benefit from that. So in 2024, we're actually going to see about twice as much gold delivery from North Parks as we received in 2023. And that's primarily a result of just higher gold grades have been realizing from some of these nice open pits that are on surface. They're not going to last forever, but we've benefited in 24. We're going to benefit into 25 as well. But the exciting story going even longer term is they're extending out the E48 sublevel cave. So that's a large cave, and Evolution's took fresh eyes and a look at the mine plan, and they found some areas that actually have very attractive gold grades for us, and they can extend the duration of the E48 sublevel block cave. And they're going to be working that starting in the back end of 25 and going forward there. So we're going to see some nice gold deliveries for many years to come from North Parks.
And you made mention of the fact that in some of the deposits, there was much higher grades. And I noticed in your marketing deck, I believe it was E31, the open pit had grades of as low as 0.13 in 2023. It got as high as 0.34 grams in 2024. Is this a trend we can expect, or is there going to be some level of normalization here?
Those grades that you saw in our deck there are actually the blended grades from the mine as a whole. So it reflects some of E31, some of E48, some of E22. So all the various different ore sources. But those high gold grade pits on surface, the E31, are what raised that average that you saw there, and that's what really drove those higher deliveries we had in 2024. We're going to see those continue into 2025, and then what's going to be taking the place of those high gold grade open pits, the E31, is going to be the E48 coming online again with higher gold grades than we've been experiencing in the past. I don't see us ever going back to the 0.13 grams per ton. It's going to normalize, somewhat around where we are right now, and have really nice profile going forward.
And we mentioned this at the onset, but North Parks represents the largest asset in your portfolio, 25% of NAV. And this is a lot of exposure to one asset. And maybe you can just expand on this, but do you think there's additional risk here, or are you happy operating in the country of Australia? Do you see any sort of risks associated with such a large asset?
Yeah, if I had to pick any one asset to have 25% of my NAV be, it would be North Parks. First of all, it's located in Australia. I mean, that is, I think, the as good a mining jurisdiction as there is to operate in. Second, as I touched on, it's had over 30 years of operating history already. I was down at site. It's in a really nice area of New South Wales, primarily agricultural. The operator actually owns the surface rights all around there. It's just well-established part of the mining community. We actually make contributions to the local community to fund some of their social programs, just to try to give back to the community that we're benefiting from. But this is an area that's just mining is very well accepted. The local workforce lives in the local towns. It's an area that you'd be happy to have your family be raised. I think it's actually probably as low a risk mine site as there is to be involved in. If I could do another North Parks again tomorrow, I would do it in a heartbeat.
Sheldon, Cerro Lindo is another large asset within your portfolio. It represents 7% of NAV, and it's a large zinc, lead, copper mine in Peru. Can you give us an update on this asset and how it's performing?
Cerro Lindo is actually our very first asset. We acquired it in 2016. We invested $250 million, and as of the end of last quarter, we'd actually realized over $300 million of cash flow. When we underwrote Cerro Lindo, we were actually expecting it to last 8 or 9 years. That was our underwritten case. And right now we're 8 or 9 years, we're 8 years into that, so it should be running out next year. But instead, our view right now is we have 8 or 9 years ahead of us still. So it's one of those wonderful sort of mines that they tend to explore as they go along and extend out the mine life. Cerro Lindo actually had one of its strongest years ever this past year in 2024. I'm looking forward to a really strong 2025 for them as well. They're benefiting from strong zinc markets and also the silver grades, which, you know, we have a silver stream on that mine. The silver grades are actually quite strong as well.
In late 2024, you announced a couple of new streams with Allied Gold. And for those who might not know, Allied Gold is the new gold company of Peter Marrone, the former CEO of Yamana. Maybe you can just give us an update on what's happening there in these two streams that you signed.
Yeah, thank you. Quite excited to enter in this deal with the Allied Gold team. As you alluded to, Peter Marrone founded Yamana, very successful story in the gold space, and now he's doing it again with Allied Gold. We actually entered into a $53 million gold stream on 2 properties in Côte d'Ivoire. That's in West Africa. It's Agbao and Bonacro are the 2 assets there. Very nice gold streams, 2 operating mines. They've been established for quite some time, good history there, and there's a lot of upside potential on these mines, which is really exciting for us. The property is underexplored. Allied's going to put money into exploration. We were able to transact at attractive rates of return, and we're just quite pleased to be involved with the Allied Gold story.
Sheldon and I want to have a conversation now on optionality. And Triple Flag has 43 assets in various stages of development. And one of the elements that makes the whole royalty model very attractive in my mind is this concept of optionality. And for a very small investment, you can make very large rewards. Is there 1 or 2 assets in your portfolio where you see this happening, where you can really gain from optionality?
Yeah, the optionality is crucial to the streaming and royalty model. It's when we underwrite a certain mine life and it gets extended, and we actually benefit as our operators spend money on exploration and development and expansion, and that's just central to our model. So I could look at the whole portfolio and point to countless examples, but you've asked for 2, so I'm going to answer the question and give you 2. And I'm going to take opposite ends of the spectrum, one a very small development and one a very large operating asset, because I think they're both very instructive. So on the development side, we actually entered into a royalty back in 2017, and we got a royalty on Newfound Gold's Queensway project. Very exciting project. It's based in Newfoundland. That company is drilling out a deposit with very high gold grades, and we're quite excited what that's going to bear in the future. We paid less than $25,000 for that royalty, so not very much money at all. I wouldn't part with it for that, obviously. I wouldn't part with it for multiples of that. So there's like the potential for outsized returns. And again, that's from early exploration stage, benefiting from the drill bit and the drill bits being funded by our partner. The other example is actually going to be North Parks, which is, our largest asset, producing, strong cash flow producer. But the optionality on that project is immense. The entire mine site right now is less than 26 square kilometers, but we benefit from over 1,000 square kilometers. And there's multiple targets on that property. When CMOC owned the property, they didn't explore it to the same extent that a number of Western companies would. Evolution Mining is now the operator, and they are very focused on exploration and building out that portfolio. So we've already seen improvements in the mine plan that benefit us. and we're looking forward to more to come.
I can't believe you picked up that asset for $25,000.
Yeah, those are nice assets to have, and there's about 200 assets in our portfolio right now that are not cash flowing. And as you get exposure to multiple ones, it increases your odds. So there's others in the portfolio as well that are just people are drilling on them, and if they hit something good, we're going to benefit, and our shareholders get exposure to that as well.
Yes, it's going to be interesting to see if and when I have a discussion with you 5 or 10 years down the road, and to see what's happening at Newfound Gold and what that asset is worth.
It's instructive that you say like in 5 years, because in the streaming and royalty sector, time is your friend. As time goes on, you tend to get positive surprises, and I think that's what makes it such an attractive model for shareholders.
So let's talk about your balance sheet now, and also capital allocation. And how are you going to allocate capital in the coming year? Are you going to focus on buybacks, dividends, or acquisitions?
Yeah, primarily I view ourselves as capital allocators. We don't actually run the mine, so it's our job to allocate capital to the benefit of shareholders. And when we started Triple Flag, we had a clean sheet. We didn't have a portfolio. We didn't start with any royalties. So the entire portfolio that we have today, it's been built by this management team, and I think reflective of our capital allocation track record. Our capital allocation philosophy is very simple and straightforward. First, we pay a dividend. Currently, we pay 22 cents a share annually. When we went public, that was 19 cents a share. So that's a 15% increase over the course of the 3 years. We've increased our dividend every year since we've gone public. I look to continue that track record going forward indefinitely. Second, we have robust cash flows, and we're going to use those to invest in more streams and royalties for the benefit of our shareholders. And I think I'm just going to pause here with the robust cash flows, because last quarter we did over 60 million in operating cash flow. That's significant. On an annualized basis, that's over 240 million. Our dividend accounts for about 45 million, so that leaves us with nearly 200 million dollars a year to make new investments for the benefit of shareholders without drawing down debt, without issuing any equity. It's just a great model for building wealth over time. And then the last element of the capital allocation is share buybacks. I think the mining sector as a whole has been plagued by too much dilution, which really impacts shareholder returns. What I really care about are per share metrics. I care about operating cash flow per share. I care about net asset value per share. And so anytime I get the chance to reduce the denominator and remove some shares from circulation, that actually adds to the wealth available for all the other shareholders that remain. Since we started our NCIB in 2021, we've actually taken out over 2.2 million shares from circulation.
Sheldon, I want to get your thoughts on consolidation now. This has been a big theme within the mining sector overall, not only in the royalty space, but also in the mining space. And in 2023, Triple Flag acquired Mavericks, and also in 2023, we saw Newmont acquire Newcrest. Do you think this is going to be a theme that we will see in 2025?
I think consolidation makes a lot of sense in the streaming and royalty sector, and probably in the mining sector as a whole going forward. You alluded to our acquisition of Mavericks Metals in 2023. That was a fantastic acquisition for us and really benefited our shareholders. We were really pleased. What we really cared about was we wanted to make sure we could do an acquisition at a price that made sense for our shareholders. That was cash flow per share accretive. It was also NAV per share accretive. And we picked up a very nice portfolio of assets that had been acquired by the Mavericks team over the course of their history. When I look back right now, and so we're now about 20 months after that acquisition closed, and I do that acquisition again in a heartbeat. There's a number of assets in that portfolio that have just outperformed the expectations, including we acquired a royalty on the Kensington mine operated by Coeur. We've had very good news flow on the Koné mine operated by Montage Gold. They have gotten through permitting. They brought in investors and a large financing package. The SK Creek mine has had a really large financing package. We hold a royalty on that. The Hope Bay property has had very good drilling results in the past year. And again, we hold a royalty on that. So I would do that acquisition again in a heartbeat. And if there's further opportunities for such consolidation, we'd definitely be interested in taking a look. It's just we'd have to do so at a price that made sense for our shareholders.
Sheldon, you and your team have been on the road for many months in 2024, attending conferences, meeting with institutional investors. I'm curious what you're hearing. What are they saying about the gold sector overall?
Yeah, I think the underlying theme is just confidence in the gold outlook going forward, and the feeling that it's not yet too exuberant, and it's also the early innings, and those of course go together. Gold's had a tremendous run in 2024, but I think gold has been out of so many portfolios for such a long period of time. I think the catch-up trade is going to be longer and higher than people anticipate right now. I was on the road, gold dropped $100 after the US elections. I was on the road talking to investors that day. I was kind of curious as to what their reaction would be. And this included like generalist investors, not your traditional gold investors, and whether there's a sense of lack of confidence. And it was actually to the opposite. There was a sense that, there's always corrections in an upward trend, that was just one of them. Since then, we've seen the gold price actually respond quite well. There's a feeling that macroeconomic events are going to provide a real tailwind to gold. The central bank buying is probably not a story that has run its course, and the interest rate cuts are still forecast for the future, which of course help the gold story. So I would say the big theme is real confidence in the gold price and the gold outlook from generalist investors, not just the traditional gold investors.
So there's still hope.
Oh, I think there's a lot of hope. I think it's beyond hope. I think it's confidence.
Well, that was a great discussion, Sheldon, and I want to thank you very much for spending time with us today. What can investors expect in terms of news flow as we go forward in 2025?
Yeah, thanks, Jimmy. Triple Flag, the story is really working for Triple Flag, and I think we're really executing the way we should. The streaming royalty model is a fantastic model, and we're not exposed to the operating cost inflation or the capital cost inflation. And so if I look back to 24, record production, record cash flow, record gold prices. As look forward in 2025, we're going to benefit from our higher production levels. We're also going to benefit from the higher gold price because the price of gold went up continually over 2024. So we're going to see really nice news flow out of that. I'm looking forward to releasing our annual results in February of this year. And then the other positive news flow that I'm expecting over the course of the next year and beyond is just the continued progress on some of the projects that we have interest in that are in development. I mentioned, the Kone project that Montage Gold is building, SK Creek that Skeena Gold is building. Beta Hunt is doing some fantastic things with their mine in Western Australia. So I think we're going to have some really nice news flow from our properties as well.
Well, that's a great overview, and I want to thank you very much.
Thank you, Jimmy. Real pleasure to speak with you.
Did you know we're now on Spotify and Apple Podcasts? So now you can listen to us on Spotify or Apple and listen and learn when you're stuck in traffic on the 401 in Toronto, the I-95 in New York, or the I-5 in LA. So be sure to subscribe and follow us on Spotify and Apple Podcasts. Ken, thank you very much for joining us today. How are things in Vancouver?
Great over here, Jimmy. We got sun today, so we're blessed.
The sun always shines in Vancouver.
No, never. Vancouver, right? Yeah, when it does, we're pretty blessed, though. It is a nice winter sunny day here. Yeah.
Beautiful city. So Tudor Gold is located in the Golden Triangle region of British Columbia. And before we hone in on Tudor Gold, I want to spend a few minutes on the Golden Triangle. For those who might not be familiar with it, it's a very prolific mining region. What's the significance of this area and why is it so rich in resources?
Well, it's one of the newer mining camps just by way of discovery. I mean, literally, the first prospectors landed at the turn of the 19th century. So it's been known to be basically high-grade, small-type deposits initially. But the thing that really handcuffed the Golden Triangle advancement was its access. Once one mine was found, Silverback Premier, that road got pushed up through the Alaskan side. Then came along the helicopter, the little, the 500, the Hughes 500 had a range of 1.2 hours. So you could just barely get to Calpine Lake, and there's a good one for you, or rather Tomory Lake with Calpine Resources. There's a blast from the past where Murray Pesam came up and discovered the famous Eskay Creek deposit, which is probably one of the most famous stories in the planet. Geologically, it's a marvel. It's something that Skeena has picked up, and they're immediately to the west of us. So we're, again, blessed with being in the heart of the Golden Triangle, right next to KSM. They've got the world's largest undeveloped gold deposit in the planet as a public company. And we are directly north of my old stomping grounds at Bruce Jack Lake, when I was part of the team with Silver Standard on that discovery that later spun out Pratium with Bob Quartermain.
So why don't we spend a minute on that, because you were instrumental in the discovery of this Bruce Jack, which is one of Canada's largest producing gold mines right now. It's owned by Newmont. Tell us a little bit about that and how it was found.
Yeah, that was, it began as the Sulphurettes program in 2006, where we drilled off for 4 years the Snowfields deposit, now owned by Seabridge. But at Silver Standard, we realized we weren't getting credit for a silver company having a lot of gold resources. So the idea was spawned with Joe, Ken, and Bob to spin out Pratium. It was the plan, as we discovered later at Bruce Jack Lake, the Valley of the Kings deposit. And I had the great pleasure of baptizing that deposit by naming it. We didn't name it until a year after its discovery. And that timeline is similar to history repeating itself to the Goldstorm story. Because here we are working on this big mammoth porphyry target, analog to, say, a Snowfields, but on top of the Snowfields, if you can imagine having a Valley of Kings. Well, in this case, Valley of Kings was well south of Snowfields. But in this case, we have discovered yet another high-grade event. And here is the story, the narrative that really gets juicy, because the same rocks, the same metallogenic trend, the same structures. We're dealing with everything as a repeat sequence just to the north. So that's what stokes my fire every morning when I get up to put my boots on to look at how many more ounces we're going to bring in through that door. But it's an impressive odyssey. But yes, that entire story of Bruce Jack was to get value, and we did a great job, from naming the deposit in 2010 to pouring Dory 7 years later. Basically, it's got to be some sort of a record in NDP government, and give them credit, because they were pro development for natural resources. Absolutely.
And I think the background on Bruce Jack is important, because I think it lays the groundwork for Tudor Gold and why investors should care, because it's only 8 kilometers away from Bruce Jack. So why did you get involved in Tudor Gold?
Yeah, that's a funny story. I was just coming off of, after post Valley of the Kings, we had a bit of a consortium down in Peru. And I was thinking about coming up and thinking about retiring. I was in my mid-50s, late 50s, and I thought, it's too early. And I sat down and had a meeting. Dino Cremonese, who was the president of our joint venture partner of Teuton, he introduced me to Walter Storm. And Walter had success at Osisko Lake, at Malartic, being one of the principals involved at the early years there. And he was an elderly gentleman. He was in his late 80s. And I was really impressed with Walter's stamina on this one, and his commitment to discovery. He was really all in on this thing. And I told him I'd look at it for him, but I said that he had his team assembled, and I thought I'd be coming in being that kind of that fifth wheel, like not really fitting in. But I said, I'll have a look at it and give you my thoughts. And but I think I'll just take it easy this year and just do maybe some reconnaissance for somebody. Dino immediately said, well, if you're available, I'll take you. And I said, sure, I'll work for you, Dino. So I worked for Teuton, but I had a good look at Treaty Creek. And I was absolutely blown away with what I'd seen. And I'd seen a hole that I'd seen, about 95 times before at Snowfields. It was a knockoff. It was the Goldstorm deposit. And it was a hole they drilled at the very end of 2018 that came back with some pretty impressive numbers, over half a kilometer. It was something that you don't see every day. So it was branded then as being Copper Bell, which was incorrect, and I knew that. Copper Bell is a different domain to the Goldstorm deposit. It's a structurally composed deposit. However, this was definitely a knockoff to what I saw at Snowfields. So I was in, and I told Walter. He met with me that Christmas, and I'm sure a guy by the name of Barry Holmes made a bet and said that I bet you Ken Konkin will come work for Tudor, and it was true. I wound up being seduced by the rocks. So yeah, I started in 2019.
That's a great backstory. So you did mention the main or primary deposit is Goldstorm. It's made up of 4 domains, and it's a copper gold porphyry. Why don't you tell us a little bit about it in more detail?
Yeah, I can go on forever with the domains, but just to try and encapsulate it, every domain is like a body part to the overall body. They're unique in their way of characteristics. We've had several pivotal points, change of direction in the thinking of the exploration, how we perceived our plan to execute to get value on the ground. And one of the biggest changes was early years, 2019, 2020. If we ever hit some copper, we knew that the copper would come in the model later, deeper. We weren't so interested in that as much as we were as becoming a gold company. But then we started looking at what happened with copper, and we thought, this isn't a bad thing. We should really concentrate on the copper domain. So the big domain that we've got is the largest one of the 4 domains. We have, as previously mentioned, Copper Bell. We've got the 300 horizon right on surface. It's a beautiful knockoff to Snowfields. The part that's the largest domain, the copper-rich one, CS 600, Copper Stream 600, 600 meters away from its upper contact of the 300 horizon. So very important. And finally, DS5, the deep stockwork. That was one we never saw coming. So all these 4 domains comprised, in a matter of 5 years of drilling, 3 resource estimates, we now sit at 27.9 million ounces of gold equivalent of a very respectable 1.19 grams gold, when the Detour mine is currently running 0.89 through the Grizzly. So very, very intriguing, given the fact when we started this odyssey, we began with the initial mineral estimate, reserve estimate, coming out at 0.74. So from a 0.74, we ramped up to about 3/4 of a gram to 1.2. So we're looking at 1.22 is the copper stream with 2.87 billion pounds of copper within that at 0.31% copper. So very respectful numbers, very respectful.
And as we mentioned, you're 8 kilometers away from Brucejack. Are there any similarities, or is there geological continuity between the 2 properties?
Yeah, the geological host rock, the system runs all the way up along the entire arc that we refer to, is a contact between the Jurassic, Triassic, is very important. It's called the Khyber Red Line. But yes, the similarities are as I was mentioning, I alluded earlier to the timeline of discovery. We were after this large porphyry system, and we had great success to it. And as we were waning at the end, one thing that bothered me, and it was that we kept hitting this now and then ubiquitous high-grade gold. And high-grade gold has no real place in a terminal part of a porphyry system. Typically, you see it as a tentacle on the outside. They're often eroded and they're long gone, but they're part of the model. But we had this episode at the end of 2023. We had 3 holes that were able to line up to make a plane, very similar to hitting SU12. When SU12 was hit, we didn't believe it at Brucejack when we actually drilled that hole, that discovery hole for the Valley of Kings. We didn't act on it because we just saw it as a one-off. Similarly, we'd hit earlier holes with native gold. We didn't act on it. We didn't tighten up the spacing past 150 meters because in a variogram, that's what we needed for drill indicator for a porphyry. When you're drilling with a hydrothermal system, you've got to choke up to no less than 50-meter step outs, right? You got to be 25 meters in. In fact, at Brucejack, we're down to 7-meter centers because the grades were higher and concentrated. But the reality was, what was this high-grade system doing way off to the north when it really, I thought, would be online with the Brucejack Lake Fault at the other end, where we have the perfect storm, which is another system, right? So there are 4 gold storm systems within the property. So I didn't predict the discovery of what we later called the supercell complex. And this is what I think you're alluding to, that we did have great success last year with confirming the thesis, the thought the hope, the dream that we had potentially another Brucejack Lake. But this one is superimposed on top of CS600. It penetrates through and is exposed beyond it. So it's a late stage event. Even the ages are lining up, we think. So yeah, and the structural complexity is very similar. One of the major differences is it's native gold, not electrum, as in Brucejack is electrum, we're native gold. We were so optimistic about what we saw. We ran ahead and grabbed a bunch of material for a metallurgical study, which we're underway with now. So watch for that press release coming up. So yeah, we're very, very bold about our decisions about going after this. So we like the idea of having a mine within a mine.
And what are your plans with or for Supercell going forward?
The Supercell complex has been drilled by at least 20 holes and pierce points through it. They've all come back with grades as good or better than what we see at Brucejack. They're averaging 8 grams. I think our average, someone had done a mock-up on it, and they came back with a number like 11 grams. I call it 10. So 10 grams for 10 meters is what my target is. So anywhere between 4.5 meter widths to 25 meter widths of high grade, going as high as 20 grams gold. Very kind of in that nice range where you don't have a spike and nuggety effect. So it has a much more homogeneous distribution. So the size is about 800 meters by 400 meters, but the drill density isn't tight enough for me to be certain to put it in any kind of a PEA. So the idea is now is to go after this underground, because the rate of return from being underground far outweighs trying to drill this thing from surface. Underground brings so many more positives to us. So the permit is now being, basically the application is going to go forward shortly. The work has been done by Fuse Engineering. We've had some work done by SRK Engineering to confirm the size and scope of how you would mine, say, the CS600 by way of block cave. So all of that development, ironically, is along the same ramp that we needed. So yes or yes, we needed this ramp no matter what to develop CS600. But why not use it to drill off all of Supercell complex right in space? So get right down to it, make that decision after we drill it off with, say, 30,000 meters of drilling, just a number. We come up with a resource on that. And the most important part, if it's positive, we're right there to knock on the door to take our bulk tonnage test to know if it's going to be, say, for an example, picking another number out of the air, 1,500 ton a day mine. Brucejack, we started with 2,200 tons a day. We ramped that up to 3,900, 3,900, just under 4,000 tons at the end of the day. So conservatively, the engineers reverse engineered it, said, yeah, 15 is a good number because you're not going to get bottlenecked anywhere. It's a nice number to start using. If we have to push it, we can push it. So let's see what we get. I think this is a spectacular opportunity, especially the price. We've been kicked in the teeth like most juniors in our sector. So we're down, but we're not out. We're definitely looking at coming back with a vengeance with this ramp that'll come down to basically validate everything we're saying with the Supercell complex.
And what's the timeline associated with this ramp?
Permits, that's a kind of a moving target depending on how busy the Ministry of Mines are. We're in contact with them all the time. So it depends on how clean the first application gets put through with a few edits. Sometime, call it 6 months to 8 months is what they've told us, roughly, which is reasonable. It's not going to be drill. The ramp work will not start this year. We don't anticipate that, but definitely contracting for it, that sort of thing. Ongoing efforts with looking at other low-hanging fruit we can get that necessarily this underground workings will not get. Are on the table. So we're going to try and look at all of the various supercells we have within the overall nebula of the Goldstorm system. And we're talking about things like Route 66, the 300 North, other aspects that didn't really fit the domain models that are probably supercells or structurally controlled micro breccias. So all these things are going to be looked at that add to the bigger picture. If you can get 3 million, 4 million, 5 million ounces of high grade, that's where you start. That's where you begin with a lower capex beginning. Every company out there that's a 2 billion plus market cap company can then look at us as a partnership, that are mining guys that can come in and say, guys, this is our wheelhouse. We do this, and we'll gladly look at that association going forward, because I think that's what would take a smaller company to build to become a large company based on what they would get at the end of the day with the CS 600. That's an absolute beast. It's huge. You've got to get on our presentation and look at the website, because within the display we've got the CN Tower for scale for you, so you can get on, have a look at that, and just compare. If you've ever been up to the CN Tower and you are nowhere near the top of the CN Tower where you're at the observation deck on that thing, you've got another 100 more meters to go. So just from that point of 450 meters roughly is where you're sitting at. It's a 558 meter tower, but you're roughly sitting at around 4 something meters. When you're looking out, just think of it. That's 3 times more is what we've got in vertical on this thing. 3 times that. And it's like takes up all of downtown Toronto. It's incredible, the size of this thing. It's a beast.
When we started this conversation, you were talking about one of the things that made the Golden Triangles successful is the infrastructure. And when it comes to any exploration company, infrastructure is very important. Maybe you can just touch on that in relation to Tudor Gold.
Yeah, Tudor's got a great opportunity here, because it's in an area that we had Pathfinder companies that came through Eskate Creek and Calpine to becoming the big deposit from Barrick days. Homestake had it for a brief moment. They put in roads, infrastructure, deep sea port, shipper facilities, concentrate facilities. All of that exists. It's currently being used by Pretium to the south of us. Our location driving from Stewart is about an hour and a half. If you actually follow the speed limit, you can get there quicker, of course. But if you follow the speed limit, an hour and a half, and great road. And I'm told the government's going to amplify it, make it wider, because they see the need for the amount of concentrate trucks coming down, putting more passing lanes in, widening the road, making it a lot more user-friendly for tourist times in the middle of the summer. But also the power line. Canada's, North America's cheapest hydroelectric. The Northwest Transmission Line was built for Galore. Seabridge is lined up to take power. It's underutilized. There's about a 30% discount to anybody grabbing it. So I think Skeena is in line to reap the rewards of the great infrastructure as well. So I expect them to be online next, along with, say, to the south of us, Artemis. That's out of the Golden Triangle, but along the Cordillera, way to the south. That's a great project. The upper portion is anyways. I like it. But definitely Red Chris to the north, from the Tahltan, and First Nations have been super with this, from Skikalmaka to Tahltan, and also every time we have a conversation with Nishka, they're all positive and give us great support.
So Ken, as we wrap up, you've already touched on many points, but maybe you can just summarize some of the key takeaways for investors and why they should look at Tudor Gold.
Yeah, my job as directing this thing is we look at, all the, we'll call them alligators in the swamp, all the negative things, and de-risking. So not only have we done a technically perfect job getting it to this level in such a short time, our discovery costs are $2 an ounce. Just on that, $2 Canadian an ounce is our discovery cost on all this. That's a phenomenal number. If you're in the $20 range, you're doing excellent. You're doing really well. So as a project that's nearly completed with a road connection, just 12, 13 kilometers to connect down straight of Valley Shot, power being right there, I think to encapsulate it, it's the right geology, the right team, and the right time, because the price is so depressed. This is the time to get in. Many people wait too long. They wait till the ramp is in. They wait until the drilling has been completed, and then the stock is at $2-3, and they've missed out. So I think that's one of the big takeaways. People recognize, get in early, and this is an opportunity at this reset after COVID, after everything slid off the edge of the planet here. I think metal prices are strong. I think we have a strong copper component. This is going to be a very bright star for a lot of intermediate to senior mining companies to look at. It's on their dashboard now. It's on their desktop for sure. I think this will be an exciting year for the company going forward, and it is at the advanced levels of exploration with a very good, competent technical team at the helm. So we look forward to giving an update with more positive metallurgical, with more positive permitting, with more positive numbers coming in through the bit discovery. And keep in mind, this is one. The Goldstorm Nebula with the supercell complex is one of 4. There's 3 others out there like it. 3 others. Just look at what KSM have. They have 5. There's 5. You could stuff half of the resources into what we've got at Goldstorm. So we have a huge blue sky, huge uptick.
It sounds like you and your team are going to be very busy in the coming months, and I want to thank you for spending time with us today and sharing the Tudor Gold story. And I look forward to touching base with you at some point in the future.
Great. My pleasure. Look forward to catching up with you later.
Hi, Joe. Thank you very much for joining us today. How are things in New York?
Jimmy, they're great. They're very cold, but we're happy to be back into 2025 and kicking off the year.
So, Joe, for those who aren't familiar with the World Gold Council, what exactly is it and what does it do?
So the World Gold Council is a member organization. The membership are the world's largest gold mining companies. We offer insights, education, information, and development around the gold market on a global scale. So whether it's providing you with the demand trends of where and how gold's getting consumed, or working in a market to develop it so that people can actually have better trusted, transparent, and access to the gold market, that's where you'll find the World Gold Council.
And you're a strategist for the World Gold Council. What exactly does your job entail?
So my job as a market strategist for the World Gold Council, in partnership with John Reed, who is my counterpart in Europe and Asia, we actually take the message of the organization, bring it not only the research, but also context around what's happening in the gold market and how to interpret it, but also making sure that the education for gold is in the market and in every corner that it needs to be, whether it's regulators or investors or anyone who's interested and looking to understand the gold market. That's what we do.
I agree with you totally. It's all about education, and that's why we're having this discussion. So I want to start with the very basics. And why should an investor invest in gold, and why should they have an allocation toward gold in their portfolios?
It's a pretty simple understanding of why they should be looking at gold. First, gold provides returns. Over the long term, when you look at the supply-demand dynamic, the gold expected long-term returns have been in line with equities on a global level at about 8.5%. So it gives you a return profile. Second, it is a very liquid instrument that when you need liquidity, you will definitely have access to it. It trades over $170 billion on a daily basis, and gold is very liquid and very liquid when you need it most. And then third, it's diversification, which is very unique. With wealth comes investment in gold, and with concern comes savings and investment in gold. So when you think about risk assets and how gold behaves and correlates, the diversification benefits are favorably linked to an up market and negatively linked to a down market, meaning when markets and risk are taking concerns to your portfolio, gold holds its value. So those 3 factors are what make it unique, different to other commodities, and actually an appropriate allocation to a diversified portfolio. And it gives you protection on the downside and opportunity to continue to see upside in good markets.
And another element of risk is volatility. And I would argue that another benefit of gold is that it's not very volatile like Bitcoin is, for example.
Well, when you talk about volatility and Bitcoin, you're really well out on the scale of high volatility. But if you look at volatility of equities, if you look at volatility of other commodities, for example, silver or oil, you're going to find that gold is less volatile for sure. And that's simply because of that unique nature of savings and also risk mitigation and concern. So it very much stands alone. I'd say to you that over the last year, with what we've been seeing in terms of the world changing and how things are dynamic in terms of the geopolitical landscape, we've had an increase in the level of volatility for gold. But on average, you're right. Risk assets have higher levels of volatility. Gold has a lower level and a much more stable level of volatility.
So let's talk about demand now. Gold had a relatively good 2024. It was up 25%, which is quite respectable. What's driving this price?
So it's a really interesting dynamic that's played out for 2024. I'd say it's been a great year. So what we've had at play have been different global pockets of the demand profile for gold, stepping in and consuming it in large scale ways. First off, the interest on the part of central banks, in particular emerging market central banks, to diversify their holdings has brought gold to the top of the list of things to allocate. So they have been consistently buying gold for the last 14 years, net long buyers of gold, and 2024 was another strong year for that. We saw the emergence of the Asian and Eastern investor come to life, and there you have markets like China and the dynamic where risk and equities and real estate are all concerning issues for the domestic investor. So allocating and getting that diversification benefit in a market like China has been top of the list. And actually, there you've seen the driving force of investors in the East picking up gold. On the Western market, we only saw the emergence of that come back online in the second half of the year. The forces that were keeping the dollar strong, rates high, started to show a shift, and that brought the Western investor back to the market. So ultimately, we've had this Eastern investor demand, then met later in the year by Western investor demand, plus the demand from central banks, keeping gold top of the list in terms of an allocation, brought on by risk, uncertainty around geopolitical landscapes, stickier inflation that basically is causing them to look at how they could mitigate that in their portfolios, and ultimately keeping that market strong and growing over the course of the year for that 25-26% return that we saw over the course of the year.
And as you mentioned, central banks have been big buyers in the last few years. In 2022, they bought close to 1,100 tons. In 2023, it was just over 1,000 tons. What's the number for 2024?
So we're close to having a full tallied number of officially reported and unofficially reported numbers that we track with Metals Focus. Right now, we're at about 850 tons, but we're still getting the final tally for December. We're not going to hit the record we saw in 2022, but 2023 was very close. We expect 2024 to be super strong, not a record, but super strong. Through November, we're at about that 850, 860 officially reported number. So we'll see where we come in the next couple of weeks with the final tally. But again, it's been a very strong story for 14 plus years now. And this has been a big driving force. It's been about a quarter of the demand on an annual basis that's coming from the central bank community, particularly emerging market central banks, driven by their interest and their need to diversify their portfolio. They are very keen on making sure we have this data in our survey reporting that we do on an annual basis. They've highlighted the need for a guaranteed level of liquidity that they need to get access to. And that's where gold really stands out for them. But I also think that they're looking at the geopolitical landscape, and that concerning landscape for them has kept that asset really high on the list of priorities for them. Whether it's a sanction risk, whether it's a U.S. Using the dollar as weapon risk, whatever it might be, where they might be sitting in terms of the proximity of some of the flare-ups that we've had in terms of conflict, all of these factors are in the minds of central bankers. And that's keeping that very high list on the list of interesting assets for them.
And is China still the largest buyer?
For 2024, through the official reported numbers, they are fourth on our list. Now, we've been getting updates over the last month, and they've come back into the market. They had a 6-month period where they stopped buying through officially reported channels. But right now, Poland is the top of the list through November, unofficial reported, followed by Turkey, India, and then China. Again, on a 10-year basis, I'd say that China's definitely been the largest purchaser from the central banking community.
So China is sitting on approximately $3 trillion in foreign exchange reserves. What percent of that would be held in gold?
I'd say it's about 5%. So they have accumulated a total of about 2,300 tons over the course of this 14-year period, for example. And I'd say to you that they're very big in terms of the space, But if you look at what the capacity could be, like you've said, there's plenty of room for them to continue to allocate, as is the case for a lot of other emerging market central banks. The US is holding near 8,200 tons of gold. So if you think about it contextually, that could give China a lot more room to grow.
And so you mentioned the US has 8,000 tons, but on a percentage basis, how does 5% of foreign reserves compare to banks in the West?
Well, I'd say that the number is low. Again, I think what we would be looking to see is more of a 10 to 15% level. And I'd say that that gives us, again, this level of expectation that not only is the case remaining quite strong with the central banking community, but the headroom is there for them to continue to add. And I think that that's what's keeping it very much in that liquid pool of things that they could actually take in and feel quite comfortable with. India is actually a good example where they have continued to buy gold, but they've also continued to bring gold back home. It's a big market. I think Turkey, as another example, had to make use of their gold reserve last year in the course of dealing with an election outcome. They ultimately needed to stabilize their currency by tapping into their gold reserve, saying, sell us back the lira to the community who was feeling a little uncertain around political future. They basically said, sell us your lira in exchange for gold. And they used that very efficiently to stabilize a political environment that could have been a little bit more risky than it ended up being.
So a lot of demand coming from central banks. What about institutional investors? Are we seeing an uptick there?
Growing, but still an area where we expect more to come. Right now, when an institution is looking at the opportunity cost of holding an asset, gold is less favorable when it comes to adding to an allocation to it. Most institutions that we've talked to are maintaining a holding of gold. They're holding it because of the risk hedge that comes along with having it in their portfolio. And I'm speaking mainly about Western institutions when I talk to this profile. But most have not added because looking at cash deposits, what you can earn in the bond market, what those rate levels at being at high levels afford you, and the cost of carrying gold in that kind of an environment, it makes sense to continue to keep the hedging element of gold in your portfolio, but not to add to it. But in a world where we start to see rates coming off, that will shift the dynamic. And we expect, and this is where a lot of our conversations are taking place, institutions saying, okay, I still have risk. It might even be greater now, but now I need to think about better diversification with my asset portfolio. So these conversations are continuing to happen, and the large scale allocations are expected to come into play into 2025. Might slow a little bit with respect to the speed with which rate cuts are going to take place from the Fed, but our expectation is that institutions will continue to look at that 1.5% to 2% allocation and maybe bring it up to a 2.5%, 3%, maybe even up to a 5% allocation into 25 and into 26 as well.
It's crazy that it's so low, 1.5% to 2%. Just, I don't know.
Well,
Shocks me.
Well, when risk assets can perform like they can, and actually cash is so plentiful, it's a comfort to know that people are still understanding that risk in their portfolio needs hedging, and that's actually what's been good for the gold market. And I think that physical gold, as well as the exchange traded funds and futures, are all instruments that are easily accessible. I think it's important to understand that risk has been top of mind for people, and taking risk is really starting to come back to a world where we're starting to understand that maybe hedging risk is just as important. And I think the drawdowns we've been seeing, and you and I had this conversation previously about how quickly risk can develop and how fast markets can move, is really starting to take hold in people's mindset. August 5th came and went with respect to the unwind of the yen carry trade. People seem to have forgotten how much the markets moved over the course of that 24, 48-hour period. And actually, people need to make sure that they cover that risk, and they need to understand what could happen in a drawdown. In our website, we have a lot of published research. One of the best charts I love to send people to is the historical drawdowns that matter most, whether it's the global financial crisis, part 1 or part 2, whether it's the August 5th date, whether it's the other moments in the market where you can actually see risk assets coming off substantially. You can see what gold can do for you. And I think that plus now a moving market for rates, that's going to bring gold back to the top of the table.
That was a great discussion, Joe. And as we wrap up, maybe you can just share with us what resources the World Gold Council offers investors to give them a better understanding of the importance of gold and holding it as an asset class.
Absolutely. We have our website, our main website, which is gold.org. It's got a resource page of everything you could imagine around the gold market itself. Within there is Gold Hub, which is where a lot of the analytics, data, and insights and research, including our podcast that John Reed and I have unearthed. We'd encourage people to listen in. There's plenty to offer through our website. If you reach out to the World Gold Council, we'll gladly take you through the investment case. We'll work with you to look at portfolio analytics and can offer our resources for free for people to get better educated on gold. In addition, we can point you to the people in the market who can actually help you implement, whether it's a wholesale bank or a retail dealer or an organization in the far reaches of the world for access to jewelry. Our people can get you to the right people for you to get access and trust the market.
I access that website quite often, so I would encourage all our viewers to check it out. There's a wealth of information on there. Joe, I want to thank you once again.
Jimmy, it's been great. Thanks very much and have a great 2025.